off their Polish unit for a while. Bloomberg had reported this potential stake back in February, and it looks like Expansion, which I believe is a newspaper, is now confirming that.
Okay, so that's certainly something to focus on, along with Airbus. More on that in a moment, perhaps. The overall futures picture then does look weak, to your point, Critty, not by a huge margin, but down 0.3% or so on Euro Stoxx 50 futures, 10 seconds to the start of Tuesday's trading session. Yesterday, global stock market sentiment buoyed by India. Certainly that is not the case today. The Indian market under pressure, falling as much as 8% this morning. And so we keep that in mind as we wait for the start of European trading. Not perhaps direct read across, but in terms of sentiment, they could make its way through to us here in Europe. In terms of the start of the European trading session, then we do have a little bit of weakness, down 0.1% on the Stoxx 600, the FTSE down on par with that. The Xetra DAX pretty stable, in fact. So it's a sluggish start to the trading day here in Europe.
It is, and we should talk about just some of the early movers. We're talking a lot about the commodity story and the read-through that we're going to see, especially as Brent crude drops now below the $80 a barrel line. Well, your biggest index weight, at least on the Stoxx 600, is Shell, Total, BP as well. So already, right from the get-go, you're seeing commodities on the back foot.
Yeah, BP, one of the biggest droppers right now, down 1.8%. Ocado, a very different space, of course, in terms of retail. That is also falling around 3%. We're looking, of course, at the airlines, and particularly Airbus, on that news that they may be selling, of course, 100 planes to China. And across your sectors then, bottom of the list then, in the energy story then, down as a sector 1.2%. Construction and materials also taking a bit of a hit, down 0.6%. So far, just one sector in the green, in positive territory, which is personal care and products, up 0.2%. As you see again across the benchmark here in Europe, Stoxx 600 down 0.2%.
Yeah, I'm glad we've mentioned what happened with oil prices yesterday a few times, and the potential for read across into the energy stocks once again today, because as you say, Tom, that is the worst performing sector, down by over 1.2%. So there is considerable downside there. But all of these sectors, really, apart from that one, personal consumer goods and grocery stores, are trading weaker today, Critty. It's pretty broad-based, this negativity.
It is. Some of the positivity, though, into the outliers, into that consumer story that you're talking about, Unilever and Nestle higher. And we should mention that Nestle was actually one of the leaders yesterday as well. So you are seeing something going on with Nestle that we're keeping an eye on. I wonder if that's simply just a large cap, small cap kind of story. Maersk as well, we should point out, higher by 3% after reinstating that guidance and actually boosting their full year guidance as well. So that's something that we're going to be keeping a very close eye on. When we're talking about investing, however, in this equity market, lots of different views about whether this is a buy opportunity or a sell opportunity. We asked that very question to Ben Ritchie, the head of developed markets over at Aberdeen. Take a listen to what he had to say.
It's always about the stock level opportunities. I think the connection between macro and micro tends to be pretty loose at the best of times. You know, the classic would be China, phenomenal economic performance for many years, terrible stock market performance. So I wouldn't connect UK macro performance with UK micro stock performance, particularly given the exposure to overseas markets, which is 75% of revenues. But there are still some really attractive opportunities within the UK. And I think it's just saying don't completely overlook a market just because you don't like the macroeconomic picture.
Ben Ritchie there, the head of developed market equities over Aberdeen, speaking to us yesterday. Let's get another perspective here. Helen Jewell, CIO for fundamental equities over at BlackRock, joins us this morning. A pleasure to have you on the program. When you watch in the market environment that we're in this morning, where it kind of feels like there isn't a ton going on the macro level when it comes to European indexes, simply because everyone's getting all of their geopolitical news and trying to digest it, is there some sort of sentiment that what's going on in, say, the Indian stock market or the Chinese stock market is setting the tone for this region? How do you view the read across?
Great to be here as always. I think when you're looking at the region, we are in a little bit of a wait and see, particularly till Thursday. And on Thursday, it's not about the rate cut. I think that's a foregone conclusion. It's about the narrative about what happens after that. If we are in a one and done, or if there are going to be more cuts to come following this week's cut. That is a really, really interesting moment for European markets. If we see one cut, and then there is indications that there will be a lot more coming through this year, I think the European market, it's not really going to happen quite so much what's happened in India and what's happened in Indian elections. The focus is very, very much going to be on the region. If it is much more of a like, we've done one, now we're back in that wait and see mode, then I think probably we'll go back to markets like we're seeing today. And what we're seeing, and I kind of listening to some of your comments there on some of these large cap names, I think it's actually the defensive ballast that have not performed particularly well over the last 12 months. People are going back into those just to provide a ballast to portfolios. But Thursday is going to be absolutely critical, not because of the cut, I think that's a foregone conclusion, but because of the narrative that comes after that.
In terms of that sectoral bias that you're talking about, the defense story, we know what defensive positioning looks like in traditional terms, but I'm curious, in this environment, when we're talking about a potential uptick in inflation or parts of Europe that are dealing with inflation, what sectors are included in that defensive overlap? Is it still healthcare, or are we talking about a consumer hedge, for example, for inflation, or is it still the mega cap tech? How do you view that?
No, I mean, I think it's all of them, but the one I'm particularly interested in at the moment is that consumer staples. You know, the consumer staples are often overlooked. They're not maybe as interesting as some of the other stocks. They don't necessarily get the benefit from those structural AI kind of trends. But when you look at what they do, they give you exactly what you want from defensive names. They give you a strong return, not hugely exciting, but regular, decent returns. And they have really not particularly performed well over the last 12 months. So from a valuation perspective, they're looking interesting as well. So consumer staples, they've been really overlooked. They've not really had much of a story attached to them. For me, that's still where your traditional defensive ballast is. But there are other areas as well. Utilities as well is always an area that you should always think about in these kind of markets.
Well, to that point, I mean, the rate-sensitive sectors, to what extent are they positioned, or at least are you able to position around rate-sensitive sectors as we get to a point where the ECB cuts and possibly the BOE maybe in August, maybe in September? To what extent do you want to be thinking about positioning to rate-sensitive parts of this market?
I think you really want to, that's exactly where you want to be thinking right now, because the valuations in those sectors don't look particularly crazy. So some of them have performed well. Utilities has not done particularly well, but other parts of that basket have done better. But real estate is another area that could be really interesting. And I think putting that ballast and putting that barbell around your portfolio is a really sensible thing to do, unless on Thursday the ECB comes out and says, we have a lot more rate cuts to come. At that point, I would lean in much more to the cyclicals, the beta names, because I think if that is what you see, that is going to be a real rocket launch for the economy, particularly the small caps. And the small caps still is where you see real valuation discrepancies. So if that's what the ECB do come and say on Thursday, Tom, I would be really leaning into those kind of names.
Do you have the confidence to lean into UK small caps at this point?
Yes. I mean, it was interesting listening to the comments just there about the macro in the UK. It's really important to distinguish between the FTSE 100 and the FTSE 250. Yeah. The 100 is very much about the global markets and those value stocks within it. But the 250, the small caps, absolutely be leading into those names if we do see the rocket launch. The big risk to those names is, of course, you've got the UK election coming up. But the UK election, the key issue there would be any kind of hung parliament. A UK election that gives you any kind of decisiveness, no matter where that decisiveness is, again, I think will really bring interest back to the UK. And we're seeing that at the moment. You know, clients are really asking us about the UK a lot more than they have before. And often you see that, you know, we saw that with Europe last year, a lot of questions earlier this year. And finally, we're seeing the flows come through to Europe. And I think that's what you see or will be seeing in the UK as well.
Helen, good morning to you. Is there any way that if we do get what polls have suggested in the UK, and that they're not a forecast, they're not a predictor, but they're a good indicator of where sentiment is right now. If we do see what the polls suggest, is that risk positive, that kind of certainty about policy outcome? Because a lot of people focus on the lack of difference between the sort of two policy proposals in a market relevant sense. Yeah. Whereas you're painting a picture of it mattering if they have a kind of decisive victory.
Completely agree, Anna. I think because the policies aren't hugely different. It's in terms of spend and where that spend might go. It's about that certainty. It's about that certainty and then looking for growth coming into the UK as a result of that. So I think certainty is what the market always likes. And again, you saw that yesterday with India. The market reacted well because it thought it had certainty. Then there perhaps is a little bit more uncertainty about what the actual outcome might be, and you see the market reacting to that. So when it comes to these kind of outcomes, certainty is one of the key things, unless you have policy differences about where spend might look. But in the absence of that, certainty is key.
Okay, so certainty is key. It's interesting because sometimes in the US context, we talk about, government getting out of the way. And sometimes when it's difficult to do things on Capitol Hill, markets kind of like that because they sense less intervention. But we've got a little way to go until November.
Yes.
We've got plenty of time to talk about that. Back to the European story, because I think it's very interesting what you're saying about thinking about what kind of guidance we get from the ECB. How do you think the ECB sells this idea that they're going to start cutting rates, but don't worry, the economy's not doing too badly. If anything, the economy is recovering. How do they get that messaging across? Yeah,
I think this is the tightrope that they have now got to really tread very, very finely. And I think this is why I'm probably more on the side of there'll be one cut, maybe two this year. But I think the kind of feeling that there will be four is probably a little bit over-optimistic, shall we say, because I think it's unlikely that the ECB, and inflation is not 100% under control right now. They will want to be super clear that these cuts are because this is part of a very clear, consistent plan and nothing to do with any recessionary concerns. So I think getting that messaging right will be absolutely critical. I think, to be fair, they've done a really, really good job so far. But that's why I'm probably more on the side of erring on the caution of fewer cuts rather than more, to be honest, Anna, because I think they won't want to kind of send any kind of sentiment that there is any recessionary concerns around this.
When we're talking about the sector perspective, I'm circling it back here in terms of valuing in the context of rate cuts, how to really look outside of the tech space for value in some of these sectors. You mentioned consumer at the beginning of this segment. I should point out, as we monitor the read-through from the Indian sell-off that we're getting, and don't worry, I won't ask you about the Indian market, don't panic, but one of the only stocks, two of the three only stocks in the green are Nestle and Unilever, the Indian branches of those, which I thought was pretty interesting, and a really broad sell-off. When it comes to the consumer story, though, how do you value that? What do you look for in the valuation there?
So what, again, it goes back to is this point of certainty. I mean, whenever we're looking at stocks, there are two things at play. You've got where the earnings are going, you've got where the growth is going. So that's the kind of top line. And then you've got the multiple. And the multiple is all down to the certainty and the risk associated around that. So you're looking at the interplay of those two things. And I think what's really interesting in those consumer names is both of those look pretty stable at the moment. So you're not having to put too much in terms of play around that. Now, as active stock pickers, again, when we're really leaning into things, that's not necessarily where we lean into. We often lean into the more cyclical names. We lean into the luxury goods space. We lean, of course, into the tech story, and where you see those structural gains. Beneficiaries of the transition as well is somewhere that we really see a lot more growth. But when you're trying to ballast a portfolio in these kind of markets, what that gives you, again, is that important word of certainty. And that's what we're really trading off in those kind of names.
I'm saying on...
No, go ahead.
On the energy front, Brent at $77 a barrel, WTI $73, so down 1.5% on WTI in the session today. Is there certainty in the outlook for oil? How do you play the energy story?
So with energy, I think it's, we've talked a lot about range bound, and I think most of the commentators who come here talk about that famous range bound of 70 to 90 that hasn't let us down much so far, and I still think that is where oil will be sitting. And that means that when we're looking at the energy story, what it really comes down to is, again, what it provides from the market and your portfolio perspective. Energy names give you value exposure, and they give you strong returns, double-digit returns to shareholders. So in portfolios where maybe we haven't got absolutely clarity of where the markets are going to sit, they provide a really, really nice ballast in portfolios. So at the moment, it's not necessarily about a play on oil prices. What it is portfolio and portfolio construction for those names.
Thanks so much, Helen Jewell. Very nice to speak to you. Helen Jewell, CIO for Fundamental Equities EMEA at BlackRock. Thank you for joining us. Let's get to some of the individual stocks on the move. Joe Easton has a briefing for us. Joe.
So we are seeing a gain in Maersk at the open, but only are up around 0.9% at the moment. At the open of trading, it was up almost 2%, and that was the best performing stock on the entire stock 600 in the opening moments of trade, just showing you there aren't too many stocks doing well this morning. We are seeing a bit of a read-through, though, in some Maersk peers, including Hapag-Lloyd, DSV over in Copenhagen, and also Kuhn and Nagel, which is over in Switzerland as well. So the shipping firms getting a boost, but not as much as you might expect, given Maersk's up their profit forecast by around $3 billion. A lot of that already priced in, as we said earlier. Then in terms of the oil impact, just wanted to bring up a couple of oil stocks because we are seeing that Brent crude price decline, as you guys were discussing there. Brent down 4% since yesterday afternoon. We're seeing Shell, Total Energies both lower today, and some very small gains in the airline stocks, given potentially that the oil price weakening is beneficial for the fuel outlook for those companies. So we can see the effect of the oil price in these stocks this morning. We'll also look at Deutsche Telekom, a big share sale from the government. They're going to plough into the railroad sector. We're seeing Deutsche Telekom coming down to 2.3%. Actually, that price there is exactly the price that they've sold the stock at today. So we can see it just coming down to that level. Quite interesting on that one for Deutsche Telekom, seeing a decline over there. A couple of consumer stocks. You mentioned Unilever earlier in the show. Now the CEO is presenting at a Deutsche Bank conference today, a Deutsche Bank consumer conference. We're going to keep an eye out for comments potentially on the ice cream spin-off and the broader market, given we saw some commentary from Nestle, the big rival, last week around demand. And note Ocado down. We are expecting it to drop out of the FTSE 100 later today when we get the reshuffle confirmed by FTSE. It's down 1.3%. It's had a bit of a decline, so will be demoted to the FTSE 250 later today. Then in terms of your morning calls, one over in the auto space, Continental. This one is a downgrade over at Bernstein following weak earnings for the tyre maker. They go underperform. Price target 54. So we are seeing some downside in that, down 0.9% today. And finally, one more positive one, Klépierre. This one is a double upgrade, much more positive. City likes this. They say the rental market in France isn't as bad as people think it is, and that stock should start gaining, they reckon. 32.50 price target, lots of upside. Klépierre is up in Paris this morning.
Joe, thank you so much. Joe Easton with a briefing on some of the stocks on the move this morning here in Europe. Let's go back to India, though, where stocks certainly on the move. The Nifty 50 under pressure, down by as much as 8% in session today. Really interesting, guys, on the T-Live blog that's running here. Our colleagues over in Asia running this blog, talking about all of the election results, but what it means for markets, what it means for the Indian economy. They're flagging what happens if we get to a 10% drop. If that happens before 1 o'clock, we'd end up with a trading halt for 45 minutes and all kinds of other permutations around whether it's a 10% fall, what time of day it happens. But be aware of that we could end up in that kind of situation if this negativity continues.
Yeah, absolutely. And Sensex down in similar territory, down 6%. The rupee under pressure, Indian bonds under pressure. Interestingly, speaking to BNP Paribas Wealth Management CIO Edmund Shing earlier, he said, look, this is nonsense, what we're saying. Ignore it. It's ridiculous, the moves in Indian equities. He says the long-term story is still there, but the volatility says you need to look through it. But it does remind us of we've been talking about this, the political risk now more broadly globally around the equity markets.
And I think it's really important for a global audience to remember that this is a country, it's the largest democracy in the world. It is mobilizing a population of 1.3 billion people, which is why that competition thread with China really comes in. When you translate that to the stock market, having exposure here, to me what's really standing out is the companies that are behind that big infrastructure push. I'm thinking of Adani, I'm thinking of Reliance. And if you look at it from a biggest kind of price change point, your two Adani listings are down almost 20% on both of them. From an index weight perspective, it's Reliance. That, of course, headed by the billionaire family, the Ambanis.
Yeah, so we're certainly seeing the fallout from this on those large caps, and there's a lot of read across into those if we don't see Modi as able to deliver on his agenda. Also, some of the small cap stocks really under pressure today, and more broadly, the sentiment is Modi going to be able to deliver on reform of agriculture, on labour markets, and on capital, and all the areas of reform that he has started? Will that continue if he doesn't have as much?
To what extent will he be constrained? Tata Steel, another one down almost 15%. The relationships between some of these executives and Modi and his government, of course, have been key in terms of build out and how they've been able to benefit from that policy agenda. So we continue across this story again. Here in Europe, we're looking at losses as well, broadly across the European benchmark of around 0.4%. Here in the UK, the FTSE 100 is down 34 points. The oil majors not helping on that front, down 0.4%. Over in Germany, the DAX is also off by 0.7%. Coming up, airline executives voice concerns over delays in the supply of new planes. We are live in Dubai next, where this year's IATA gathering is being held. I believe we're going to cross over, in fact, to Berlin. It's the Air Show Berlin as well. Guy Johnson is on the ground in Berlin. He has been talking to a lot of executives. We have the news, of course, around Airbus selling, at least hoping to sell around 100 wide bodies to China following a meeting between President Macron and Xi Jinping. So we watched that as well. But more on the airline sector after the break. This is Bloomberg.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Demand environment, I think, remains quite robust. It's recovering slower than we had expected, principally because of the Chinese market in terms of international travel to and from China. But I think that's a timing issue, not a plateau.
We're blessed to be in a region that is growing a lot. GCC is growing a lot. I mean, Saudi Arabia is growing a lot. The UAE is growing a lot. India is growing a lot. It's just 3 hours flight, right? Yep. So it's sustainable.
Right now, in terms of engines, we do not have that problem, which the peers or the industry is facing. In terms of aircraft delivery, of course, we face some delays, but which are manageable, I have to say. I mean, it's like several weeks for that.
In the supply chain, we are having trouble sourcing parts for interior cabins, for engines, that type of thing.
We're experiencing more severe turbulence, and we haven't had a significant incident yet, but we are taking all the precautions we need to keep the safety of our customers and our crew to the maximum.
Airline executives at IATA's annual meeting in Dubai, talking about the supply and demand story, but also talking about some of the safety issues with regards to turbulence there. Let's get more on the gathering from Bloomberg's Sid Phillip, who joins us now from Dubai. So the IATA conference has been taking place there then, Sid. What were the biggest themes? We heard some of the executives talking about them just now.
Morning, Anna. So the biggest themes at the IATA conference this year were both supply chain issues, and also we've heard a lot about airline executives talking about pricing and the fact that pricing isn't really going further from where they already are. So everyone's been talking about how there's a high plateau, and that's where fares are going to be for a little while, because it does seem to be suggesting that the consumer don't really want to pay as much anymore to fly, and so airline executives are looking at ways to try and maximize their margins.
And when we talk about maximizing those margins, what does the consumer demand story actually look like right now? It feels like we're getting mixed messages from the data. Are the airlines giving us any insight?
So the airlines have been talking about how demand is still strong. It's just the fact that people aren't willing to pay as much as it takes to get onto a plane. And I think that's sort of the messaging, that revenge travel boom that we saw coming out of the pandemic, and especially last summer, that might not be the case this summer. And we're sort of already seeing carriers like Ryanair and Wizz Air, which weren't really at the IATA AGM, but they have been talking about how they have to stimulate demand with discounts, and that may be something that may be wider spread. But airline executives still sort of talking up the demand story and sort of saying they can't get enough planes, they can't get enough parts for planes, and as a result, capacity is constrained.
Sid, talk to us about this deal, this apparent deal between Airbus and China. 100 wide bodies being sold by Airbus to China. When are they expected to be delivered? Why is the demand? Why are Chinese carriers looking to take on additional Airbus? Is this a snub to Boeing? What's the Comac play here as well, their own domestic aircraft maker?
Yeah, there's a lot of factors at play here. So wide-body aircraft have seen a resurgent demand, and that's because long-haul travel is coming back after the pandemic, when basically there was a shutdown. And airlines are now sort of ramping up their wide-body fleets. They're looking for new aircraft. They're looking to replace older aircrafts. And that's really led to a backlog that's been growing. And now the Chinese carriers are also sort of waking up to the fact that Airbus and Boeing both have order backlogs on their wide-body planes that stretch into the 2030s. We saw that last year with the narrow-bodies, where narrow-body aircraft deliveries were going into 2031 and 2032, and now we're seeing that with wide-bodies. And so the Chinese carriers are looking to replace their older aircraft. They're looking to replace aircraft that have been in service for a number of years, and so they're in talks with Airbus to order as much more than 100 aircraft. And so at the moment, there's a lot of geopolitics obviously at play. I mean, the US and China have a complicated relationship, and that may be a factor in why Airbus is seen as a frontrunner in this deal. But we still don't know what the timing is, when the deal might be announced, what the final contours are. And also, I mean, don't forget, Boeing's also got its own problems with supply chain, and they have to sort of sort out how they can get their 787 and 737 production back on track and actually deliver all those aircraft that they already have in the backlog.
Okay, Bloomberg's Sid Phillip on the airline industry, the demand out of China and that backlog stretching into 2030. Sid, thank you very much indeed. Just checking the Japanese yen, a little bit of strength coming through for the currency. Currently up 0.3%. Some lines coming through from the Deputy Governor of the BOJ on monetary policy. Monetary policy shouldn't target FX itself. Monetary authorities should watch FX impacts on prices. Officials out of Japan recently confirming the intervention, of course, that happened last month. There's plenty more coming up. A deep dive on Indian stocks. More details next. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
The photo ops are in full swing as the UK general election kicks up a gear. But whoever wins that contest will face a harsh truth. The UK has a massive debt hangover, and that threatens to tie the hands of the next government and to collide with spending pledges on things like defence, healthcare and education.
The UK spent big during 4 years of crises, from COVID to the energy price spike following Russia's invasion of Ukraine. Government support measures during those successive disasters cost around £400 billion. Both parties supported taking a generous approach. Now, though, the bill has come due, with national debt at a level not seen since the 1960s. Servicing that debt in a world of high interest rates is costing an extra £60 billion a year. To put that in perspective, that's equivalent to the entire defence budget without a bullet to show for it.
And now creaking public services are crying out for more funding, with much desired economic growth seeming elusive.
Well, the election debate so far has really been focused on how the parties are funding relatively small pledges on taxes and spending. But this misses the far bigger picture of an unprecedented peacetime rise in debt, rising taxes. What's really happened here is that the fiscal debate has got detached from that fiscal reality.
Rishi Sunak claims the economy has turned a corner, with inflation falling back near the 2% target.
Thank you.
Meanwhile, Labour are on a mission to assure business that they are the party of economic stability. Regardless, the UK faces a mounting bill with no easy way to pay it off.
Bloomberg's Alex Morgan there with a look at the debt issues that face whoever wins the election here in the UK coming up on the 4th of July. It's interesting because in that sense, it seems like there's almost nothing at stake because they both face the same problems. But from a political perspective, we could be witnessing a really, really bad outcome for the Conservative Party if what we see in the polls turns out to be true. I mean, we've got the MRP model. It's not even a poll, but it's this MRP model which goes deeper than a poll from YouGov, talking about how the Conservatives could have their worst year since 1906.
Yeah, it's the polls are looking pretty dire for the Conservatives at this point. Of course, they will continue to point out, they would make the argument that the economy is turning around on inflation, on growth. The Institute of Fiscal Studies, this is an organisation you've name-checked as well, Anna, and rightly so, in terms of broadly the picture, the fiscal constraints on any government that takes over after July the 4th, and the fact that they're just not going to have that firepower. the expectation is you're going to have to you're going to either raise taxes or cut spending to kind of deal with the debt overhang and rewrite the books here in the UK. And it's going to be a long and painful process for whoever is in office.
So as we get these kind of pieces of policy perhaps kind of rolling out, it feels like there's real complacency in the market, perhaps to your point about that fiscal headroom just not being there. But I'm curious if that just sets up the stage for when the manifesto does properly come out and you see it in its entirety. Is that when we see more volatility?
Is there still room for volatility around this election? Yeah, you do wonder. You know, the Labour Party has been, especially in the wake of what happened with Liz Truss and her administration, the Labour Party very keen to portray the image of not taking too many risks, certainly on the debt side of the UK economy. Is there still any room for that narrative to change as we get closer to July 4th?
Yeah, and our previous guest, Helen Jewell, saying, look, a hung parliament would be a risk for these markets, and maybe India is a reminder that we shouldn't put too much, or at least we should caveat how much weight we put on the polling, because, of course, you saw this big upside in the equity markets yesterday. These were exit polls, of course, importantly, we're talking about, not the kind of polls we're talking about here in the UK. These were exit polls out of India, but you saw this rally of 3% plus. That has significantly turned around in the session today. Severe drops across the equity markets of India. The rupee under pressure, bonds under pressure, the Nifty 50 down 6%. It's reversed some of the heavier losses. You're looking at losses around 8% early in the session, currently down 6%. Similar picture, of course, on the Sensex. Some superlatives as well in terms of how you end the day. 12:30 UK time is when Indian markets close. You could be looking at losses of hundreds of billions of dollars because, of course, the market is so much bigger. And that could be, you're looking set for potentially the biggest daily drop in terms of market cap for India, potentially on record, guys.
Yeah, absolutely. So in terms of where we are on the India story, let us bring into the conversation Shumita Deveshwar, TS Lombard's chief India economist, to give thoughts on what's happening in the India story. Shumita, really nice to have you with us. We see a lot of reaction in markets to expectations around this election. We still don't have the result here. What's your early thinking about what the results at this point mean for the Indian economy?
I think as far as economic policy goes, the big risk is possibly increased fiscal spending, because this verdict may be read as one where rural distress and a lack of job creation has hurt the current government. And we've talked about this before, that the lack of job creation, despite India's high economic growth, has been a prime voter concern, even going into the elections. All the opinion polls preceding the elections that began on the 19th of April show that unemployment ranked as the biggest voter concern in India.
And so you're taking you're suggesting then that we don't see a stronger turnout for Modi as many had anticipated, or certainly as he had anticipated, and he set the bar for his own success as pretty high. Shumita, in terms of what, and that's interesting that you talk about rural distress and a lack of job creation, what does this mean from a policy perspective? What are the policies that he would have been able to implement that maybe he'll find it more difficult to implement now if he is constrained, if he's not given as big a mandate as he'd hoped?
I've always said that as far as the reforms go in India, the reform policy goes, that it's always done in an incremental, gradualist manner. I don't see that changing between Modi's, second term in power, or whether, he comes back to power in the third term either. I think that, and even if any other government is formed with someone else at the leadership, I just don't think that the reform program really changes much, that it's always done in a gradualist, incremental manner across successive governments. Where, as I mentioned, that I do see the prime risk is of increased fiscal spending, because I think that one thing that the Modi government can be credited with is a fiscal discipline, that, after the surge in spending during COVID, he has managed to bring down the fiscal deficit and has had a fiscal consolidation path marked out. I think that's where we will see the risk, because I was actually on the ground during the elections, traveling through 3 Indian states. And what I found again and again in each of the places that I went to was that people are asking for more from the government, because they're not getting enough success as far as their economic lives are concerned. As I said, that lack of jobs and and livelihoods are a big concern across vast swathes of India.
Yeah. So potentially a pressure point then on the incoming administration to do more on the fiscal front to support and address some of those challenges. But of course, that raises questions about funding, about the debt markets, of course, and fiscal expansion in India. Shamita, how do you expect the relationship between any Modi government and the RBI to evolve in the months and quarters ahead, and how consequential that could be?
Closely. So I think that India does have a credible central bank, and they have done a good job in terms of controlling inflation. That's been one of the big success stories, in fact, I would say, of the central bank. But if you see things like, the RBI paying the government record dividends, which then, of course, goes into the government programs, even the public sector companies are paying the government dividends. And so these are some of the revenue sources that the government is pulling in and then employing to use as far as its own welfare schemes are concerned. And as I said, I think that, that every political party, even if you see the regional parties that are fighting the elections in states where the national parties are not very strong, everyone seems to be competing with each other as far as, welfare policies are concerned, because, on the ground is just a very different picture than, the high growth rates that we see. So I think that, that this is the way forward for the Indian economy.
Shamita, the story that stands out for me and in terms of this election, the voter demographic, is where the state of Punjab in particular stands. When we're talking about asking for things, when we're talking about getting some of those subsidies and even the employment story, this is a region, for our international audience, we should be clear, that specializes in finance. It's mostly farmland and, of course, has been largely subsidized by the government, but is dealing with a lot of that unemployment story as well, to the point that some of those farmers' protests that you saw in the likes of Brussels, France, arguably in the States as well, you also saw in India Punjabi farmers coming, of course, into New Delhi with their tractors. Shamita, in the context of still higher inflation, higher food prices in India, square the circle for us there. How does that all connect?
So the agricultural sector is the one sector that has really been untouched by any kind of liberalization of policies or reform. And when the government did tend to, the Modi government in its second term, did push through these farm laws through parliament, it saw massive resistance because farmers thought that they're going to lose government protection and that corporates are going to come in and they're not going to be protected against, big companies. And some of that trust with the government was lost. So we saw these massive protests, as you mentioned, tractors basically surrounding Delhi and stopping traffic from moving. And these lasted for a long time and they were very controversial. And in fact, just before the Uttar Pradesh state election, which is one of the biggest, it is the biggest state in India as far as, the number of members to parliament that it sends. Modi actually withdrew the farm laws. He came on national television, apologized, and withdrew the farm laws. So that really shows the tension that, that there is this sector, the agriculture sector, that needs desperate reform, where all this rural distress is happening. And yet farmers, because they've been used to government support over so many decades, are unwilling to lose that. And that's where the conflict comes, I suppose, between development and making sure that, that there are enough welfare policies to keep the voters happy.
I love that you mentioned the UP story. It's so important, again, when we talk about just the politics that are at play here. Shamita, I want to ask you about the farming story in the context of the global markets, because Modi has also been very vocal about some of his protectionist policies, especially during COVID times, with some of the rice exports, for example, to the rest of the world were then rerouted to kind of tackle the domestic demand. What might that look like moving forward?
So, this happens all the time. So one of the most interesting stories that I saw when I told you that I was on the ground, looking at the elections, was in Maharashtra, which is a big onion-producing state. And as food prices went up, the government came in and imposed all these export controls, and the prices plummeted. And farmers and the wholesale traders were up in arms against the government. And we're seeing that, in fact, play out in the election results, where basically in Maharashtra, the BJP alliance is not doing very well. So these are, every state has its own politics, and at the same time, the government needs to control the prices for products at a national level to protect consumers. But as a result, it leads up, it's like a game of whack-a-mole, that you try and control one problem and another one crops up. So as I said, I think the agriculture sector, it's very difficult to figure out how to reform the sector, which is why successive governments have been unable to do it. And at the same time, all these government interventions don't really play out either.
Okay, Shamita Devashwar, T.S. Lombard's chief India economist, thank you very much indeed for the context and the reform challenges facing the future government of India. Let's check in on the oil markets now. India, of course, a major importer of oil, but checking in on Brent, down 1.1% down in session at $77 a barrel. WTI taking a further hit after the losses and the sell-off of yesterday, $73 on WTI. I wonder if this is a combination not just of OPEC Plus, but maybe also of the softer data out of the US. But the sell-off continues.
Yeah, sell-off continues on oil then, and it took a while to get going, didn't it? The post-weekend sell-off in oil, but it certainly was with us yesterday and with us once again. We're off earlier lows, so we have been down a little bit more than this, Critty, but energy stocks were down by more than 2% a moment ago, now down by just shy of that.
Yeah, it does feel like it's a little bit of a catch-up trade, because we see so much volatility in copper, so much volatility in gold as well, and even, by the way, in the face of this Indian election that we've been talking about, these markets spilling over, gold has been relatively complacent, whereas you are seeing, to your point, Anna, that volatility in the oil story. Suddenly, the dollar effect isn't equal among all commodities, which is what we've seen in the last, I want to say, 7 to 10 days in the trade.
Coming up on the programme, we will put some of the social media posts around GameStop front and centre. We saw them yesterday sending GameStop shares surging again, but could the author of those posts get kicked off a major trading platform? We'll discuss that next. This is Bloomberg.
My greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill, is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Markets today. We are 48 minutes into a European trading session that is under a little bit of pressure, down down 0.3% on the 600. The FTSE 100 is down by around 0.5%, and the German and French markets down around 0.3%. So modest losses, perhaps. Some of the US sentiment around that ISM data, perhaps weighing a little bit of focus on emerging market policy risk. Perhaps that's weighing. But energy stocks selling off here in Europe. We'll get to that later. But energy stocks are under pressure today, and all of that weighs on the European session in hand. Let's get to something that has certainly dominated some of the trading in certain areas of the market in recent sessions. The meme stock personality Keith Gill, better known by his Reddit handle Roaring Kitty, could be sitting on a massive payday. He posted a screenshot of what appeared to be a $116 million position in GameStop, which sent its shares surging. But it's led to reviews by the trading platform E-Trade and by the US regulator, the SEC. Let's talk to Bloomberg's Charlie Wells, who's, of course, across this story for us in great detail. Charlie, thank you very much. So what's propelled this rally in this meme stock once again? Is it all about what Keith Gill is doing and what we assume he has as an exposure here?
It is. I mean, it calls to mind not just 2021 when we saw that massive rally in GameStop and other meme assets, but also last month when Keith Gill returned to Twitter and we saw a big rally there. Different month, different social media platform. This time it was Reddit, where Gill was showing that he had this large position. Interestingly, he also indicated that he has 120,000 call options, the right to buy those GameStop shares at $20 later this month. And this just speaks to the fact that, this rally may or may not have legs, but this phenomenon of certain influencers in social media having the ability to bring large crowds behind them, that is continuing.
Some reports reporting out of the Wall Street Journal, I believe, that E-Trade kicking off Keith Gill off its platform, or at least considering it. This is, of course, the online platform under the parent company of Morgan Stanley. I'm curious how feasible that is, given that... Well, go ahead.
No, it's a really interesting question. I mean, I think there's certainly a debate within E-Trade over, do they kick off someone who could potentially be seen as manipulating markets? People familiar with the matter told the Journal that no decision has been made. But what we know is these brokerages, they do have wide latitude to kick people off their platforms if they want. They can look at a lot of this activity. And what people familiar with the matter told the Wall Street Journal in this report was that they saw a large volume of options purchased last month before that tweet that rocketed the GameStop share price up. So the consideration there is, what is the SEC looking at? But the flip side of that is this market manipulation? A lot of these communications are vague. And of course, there is that massive army of supporters behind GameStop, behind Keith Gill, who could also leave the platform and cost E-Trade customers if they kick Gill off.
Yeah, it could bite back if you click the claws of Roaring Kitty, maybe. How is it that one man can make such a move across these meme stocks? Talk to us about, I'm going to steal one of Critty's favourite words, or phrases, which is market plumbing. The New York Stock Exchange yesterday, another glitch. It's not the first time. A couple of times just this week. What on earth went wrong, John?
Yeah, Tom, so some of those pipes in the plumbing looked like they were kind of, veering in a strange way yesterday. And it was looking early yesterday, like if you wanted to buy Berkshire Hathaway Class A shares, you could get them.
It was a bargain.
Yes, 99% discount. I think they had closed Friday at $627,000. They were going for $185. And now look, this looks like a lot of these issues, not just that kind of strange pricing, but also some of the halts, that was related, the NYSE said, to a glitch in software that governs opening price display on a feed that consolidates bid-ask quotes. And this is related to limit up, limit down halts. Now, something a little bit ironic there is those limit up, limit down halts. Those are intended to protect investors against volatility. Yeah. Of course, yesterday morning we saw a lot of volatility. We know that this was ultimately fixed. They were able to revert to a backup data center, and those discounted prices on Berkshire Hathaway, those are going to be canceled.
Yeah, the bargain bucket Berkshire Hathaway trade is not going to pay off ultimately, is it? They're not going to push those through. Market plumbing, why do they do these software upgrades in the middle of the trading day? Why don't they just do it on a sleepy Sunday or something? Charlie Wells explaining the complexities of the market plumbing, the NYSE, and another glitch there. Charlie, thank you very much indeed, and on the meme stocks as well. Here's what else to watch out for today, 3 p.m. UK time. It's the US factory orders, of course, after we got ISM manufacturing coming in much softer than expected, and JOLTS as well, job openings out of the US. Important on a week when we get non-farm payrolls on Friday. Later, US earnings, including CrowdStrike and Hewlett-Packard, so HP, of course, in the hardware space in terms of technology and IT. Then we continue to wait out, of course, the details around the Indian election. We are getting the vote count, of course, and those continue to ripple through the equity markets, but also, of course, the currency and the bonds of India. We'll keep across that.
Yeah, absolutely. So all things India in focus. Finally, we also had the Berlin Aviation Summit taking place today. IATA was all in focus yesterday over in Dubai. Today, we're all about what's going on in Germany with regards to this summit. We're going to be having some really interesting conversations. Guy Johnson on the ground there, Airbus and Boeing CEOs at this summit. Bloomberg's Benedict Camel will be speaking with the Airbus CEO, while our markets today, colleague Guy Johnson will be interviewing the Boeing boss. That's at 12:10 UK time, 7:10 in New York. You can also watch on Live Go, of course. So plenty of aviation this week, both yesterday and today, as we continue to monitor that. We might get more on that. Bloomberg's story earlier around Chinese orders coming through for Airbus, and we know a lot about the travails of Boeing over in China, of course. Chrissy, your mind perhaps elsewhere right now, heading off to super return.
I am, but also meeting up with Guy Johnson in Berlin. That seems to be where the party is. This is a really important story. We know that Jamie Dimon made those comments, I want to say, 2 weeks ago or so, saying that perhaps the cracks in this market, or the early signs of it at least, could show up in the private credit market. We also know that in this environment, we've been talking about it all morning with the EM spaces, people are trying to find yield. They're trying to find that return in an environment where you're not really getting it in the bond market. It's hard to navigate. So therefore, maybe they're allocating to alternatives. And that's the conversation we're going to be having at Super Return, the largest private equity conference in the world. We have a great lineup. These are just some of the guests that are showing up on your screen out of Morgan Stanley, Goldman, Vista, billions of dollars at play here. Danny Berger will be joining me as well. Apollo, KKR. We've got the whole gambit. Yeah. You do not want to miss this coverage.
And a lot of the coverage in recent years was all about the rising rates environment, and a lot of the conversation, the pushback from the industry was, well, look, there's expectations that rates will be cut, and then now, you're going to this event and going to be asking questions about what their expectations really are for rate cuts as the market toys with, well, 2, I think we are today.
Yeah, I'll give the viewers a freebie. I think my first question is going to be, we're seeing so much momentum in the equity market. You're seeing so much momentum in the private credit market. When the party keeps on going, how do you know when it's about to stop? How do you position for that? And of course, private credit is a very illiquid area of the market, and they're dealing with massive amounts of money. You can't exit it as fast as you can enter it the way you can in the public markets. Another major story or major theme we're going to be keeping an eye on is the fact that so much money is wrapped into private credit. Hedge funds are starting to say, well, how are we supposed to deploy capital into the public markets? Because the same institutions, endowments that are funding private credit also are supposed to be funding hedge funds, and there's a little bit of a liquidity crunch, speaking of market plumbing.
Lot to unpack in terms of the world of PE, and you and Danny Berger will be doing that, of course, on the ground for us in Berlin. Checking on the European markets now, the Stock 600, the benchmark, is currently down 0.3%. Here in the UK, the FTSE 100 off by 0.5, down 42 points. US futures also pointing lower modestly, down 0.1%. And one wonders is if the non-farm payrolls is the next catalyst, particularly for the US markets.
Yeah, that's Friday, isn't it? We get JOLTS data today, and so any weakness in that job opening story is going to be watched for. That's what Bloomberg Economics is watching for. But to your point, Friday, non-farm payrolls were all about the jobs once again.
I'm so curious about this euro-dollar trade, and Helen Jewell was talking about it, right? It's not about whether the ECB cuts or doesn't cut on Thursday. It's about what guidance they give after, followed by the dollar story on payrolls. Friday's going to be a really fun day for you guys.
Excellent.
Vanguard seeing rates down to between 2 and 2.5% or thereabouts by the end of next year.
Lots to look ahead to then at the end of this week. That is it for markets today. The Pulse is up next. We'll leave them to take you through this slight softness in European equity markets, certainly softness in commodity prices this morning. This is Bloomberg.
Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. Actually, I'm not in London. I'm in Paris because we had a great New Voices program. Here's what's coming up on today's show. Indian stocks, bonds, and the rupee slide as early results point to a narrower than expected win for Prime Minister Modi. Ahead of the ECB decision on Thursday, some investors are dialing back their rate cut expectations for the year on strong economic data. Plus, Intel fires back at NVIDIA over its claim that traditional processors are running out of steam in the age of artificial intelligence. So good morning, everyone. There's a lot going on in the markets today. Let's first of all look at the European markets map, but actually the big surprise is what's going on with Indian assets. Now, a couple of things that we should alert you to. First of all, expectations in terms of ECB cuts have shifted slightly. European stocks a little bit under pressure. Again, investors seem to be weighing concerns about the health of the U.S. economy against some stronger expectations for early Fed policy easing. So I'm looking at the CAC 40 here in Paris, down 0.5%, as is a FTSE MIB and the UK. But the other very big, of course, spotlight is India, where the country's stocks, but also the currency and bonds are all dropping. And this is on initial ballot counting, signaling a narrow victory for the Prime Minister Narendra Modi. And this means that some of the things that have been put in place, for example, the cutting of red tape, could come into question. You can see the MSCI India index down 5.9%. So we keep an eye, of course, on what's happening in India and look at the way forward. Again, it's a stunning result after exit polls that showed that he was on pace for a landslide victory. So this is Mr. Modi. We look at some of the policies in place and, of course, what this means going forward. So the slimmer than expected victory for Narendra Modi's alliance will raise questions about the new government's ability to push through difficult reforms in land and labor laws, an agenda seen as crucial by some investors to sustain India's economic growth. So let's get more now from Bloomberg's South Asia economy editor, Rushi Bhatia. Rushi, I mean, this is a huge, huge surprise. What are the key numbers to watch for as counting continues in the next few hours?
Hi, Francine. Absolutely a big surprise coming in. The exit polls had predicted a landslide victory for Prime Minister Narendra Modi, but so far, after nearly 5 hours of counting, we are halfway through the vote count, and the numbers show that it is a close contest between the Bharatiya Janata Party, the ruling dispensation, as well as the Congress party, the opposition-led Congress party. The BJP and their allies are still close to the 272 mark, which is the halfway mark that is needed for them to form the government. But it does look like that the opposition parties have given a tough contest this time around to the BJP. And, some of the issues that the BJP really took to the voters, that have not really worked well for them. Also, the winning margins on several seats is very slim, and it goes to show that the opposition alliance's strategy to not contest against each other seems to have worked this time around.
So equity and bond markets are reacting pretty badly to this upset. I don't know whether it's because it was unexpected or actually they have real concerns about some of the reforms going forward.
Oh, absolutely. As far as reforms are concerned, it does look like that Narendra Modi's BJP will find it very tough, because every time in India we've seen if a coalition government comes in, then it becomes very hard to push through critical reforms. Even when the Bharatiya Janata Party in the last two polls, when they had a big majority, they were not able to push through critical reforms like land, labor and the farm sector reforms. Besides that, it is quite likely that the new government will have to give in to the demands of the allies and will have to push through welfare policies, because we do see a wide rural distress in the country, and that would mean some sort of a slippage on the fiscal numbers as well, and that will not be seen very well by various economists and analysts. Remember, S&P has recently said that India is on the watch for a ratings upgrade, and if India falters or widens its fiscal deficit going forward in the next budget, that is in July, it is quite likely that the rating agencies will certainly not like it.
Rushi, thank you so much. The biggest story today, of course, it's what happens next and some of the reforms as we continue counting and looking at news from the counting of the votes. Rushi Bhatia there looking at the Indian elections. Now, robust economic data in Europe and vocal ECB hawks are also pushing some to waver in their expectations for interest rate cuts this year. Well, joining us now is Elise Badois. She's head of EMEA Equity Research at Citigroup. Elise, as always, thank you so much for coming in. There's a lot of focus on what happens with the ECB on Thursday. It's widely expected that they cut. But has the market been too presumptuous that once they cut, they continue cutting almost at every meeting?
Morning, Francine. Well, we've recently reined back our expectation for sequential cuts, and we now expect the ECB to cut this coming Thursday, and then subsequently, probably now in September. What our economists are really seeing is an environment where there's no particular, actually, and it's an unusual environment. There's not particular pressure for the ECB to act in a certain direction. Inflation is now looking like it's moving in the right direction. Financial markets are behaving properly. And obviously, we've got a number of other factors. The geopolitical scene is very active, although not very, very reactive. But I think the most important perspective from our economists lately is they have actually upped a little bit their view on terminal rates from 1.5% to 2%. So that means slightly higher rate for longer, which we think is actually not necessarily a risk or a negative for the European equity market. In fact, we believe that could actually be a paradigm or a setup for equities to perform.
I was going to ask you, Elise, what does that mean for actually, I know you have been very constructive on equities in Europe, but does it remain the case? And do your targets change?
So over the next, essentially, we've seen obviously a strong rally for European equity market, but that's been synchronized with the rest of, with equities in general. What we believe is longer term, we might actually see a different environment for European equities specifically. So pre the global financial crisis, we were in that environment where you had, higher inflation or slightly higher inflation, more around 2%, and we had slightly higher rates. And this is an environment that actually has seen European equities not being this sort of serial underperformer that we had seen. Now, obviously, I'm conscious that, over the last few months, we've had a relatively interesting European equity rally. And in fact, we've seen in the last months, for the first time in 12 months, inflows into European equities. And actually, we are constructive over the next 12 months. We have a balance of risk. We still have some risks. But I think longer term, some of the sectors that make up the European equity markets, like, for example, financials or industrial cyclicals, are sectors that tend to do well with actually slightly higher rates and slightly higher inflation than the sort of zero rates or very, very low inflation environment we had prior to the shocks that we've seen.
So, Elise, how do you build a portfolio? Like, how much is it weighted towards cyclical stocks and industries?
So currently we are overweight, for European equities specifically, we are overweight cyclical stocks. So we are overweight essentially tech, base materials, and also industrials. Probably not autos at the moment, particularly because we're seeing a lot of competition, out of China. But that's for the cyclical end of things. We would favor those three subsectors. And then obviously, should you want some exposure, slight exposure to defensive, we would favor healthcare as our favorite defensive play.
Elise, I know you've also identified three risks or catalysts, and you mentioned China. You've mentioned, of course, geopolitical risk and the fact that there's always a danger that interest rates stay higher for longer. Is there a danger? What's out of these three the biggest danger, actually, that could move around in terms of targets and expectations?
Actually, the largest risk we see is at the moment we have, we don't have any external shocks, and external shocks are the biggest risk we see. So particularly supply chain risks that we could see. So geopolitical risk, etc., via obviously the communication mechanism of oil are some of the risks that we could see from the outside. But in terms of as far as the market is going, we are right now. We won't have much fundamental news. We'll have that at the H1. We've seen margin holding up, a very good set of Q1. If we sort of ease into that going into the summer, we could be more constructive on EPS growth. At the moment, we're forecasting 6% bottom-up EPS growth, and we could see that consolidated after the H1 results.
Elise, talk to me about margins. I know you put out a very interesting note looking at a breakdown of some of the European companies or sectors and what kind of margins we can expect. Again, is there a valuation play between U.S. equities and European ones?
So obviously, the key question from investors at the moment is constantly around margins, and that's because we have inflation that actually is receding, and usually margin tend to move with inflation, i.e., if inflation recedes, then you tend to lose that gain you had from higher sales, and those better margins tend to recede with actually receding inflation. So that's a valid investor concern based on history. What we've seen actually is really good margin resilience. And we anticipate that that's likely to continue and be confirmed as we head into, the half-year results. By sector, how that looks like is, you do have some sectors that have perhaps been challenged in the past that might actually come out better. Again, something that would actually favor cyclical plays and particularly industrials.
Lise, when you look at politics, and it's very difficult, for example, to see some of the policies really in place that will come out of the U.S. election, depending on who's in the White House. But again, is there a danger that actually inflation, there's an uptick because of geopolitical tensions, but also maybe because of protectionist stances that could come in place?
I think I link that's the key question, and obviously that's linked to the view of our economist. What actually is the premises of our view for higher rate for longer is this perspective of of the fact that both energy transition, but also geopolitical, what I might call geopolitical transition to a world where security is very important to policy. Obviously, that is inflationary, right? And from that perspective, that's where we end up in Europe, which is highly exposed to the US, with a higher terminal rate of 2% versus 1.5% that we were previously forecasting. That's based on the premise that the world we live in could be slightly more inflationary for longer. Now, obviously, that doesn't come as a straight line, and that tends to come more as a shock to supply chain, and obviously from an energy transition perspective, that could come as a supply chain shock, for example, with a climate change event. But also it comes with policy, with, this view that we have to be, obviously here in Europe, we have an election in the UK, and one thing that actually isn't controversial is, I think, the view is that everyone, both sides agree that we should probably have, more spend on defense. And I think that that's an unusual setup, which, in the past, it was more bipolarized.
Elise, as always, thank you so much for coming on. Elise Badwater, head of EMEA Equity Strategy at Research at Citigroup. Thank you so much for joining us. Plenty more to come, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We have a long-term relationship with Paris because we've been here for more than 70 years, but to your point, we multiply by 9 or 10 our headcount here. And that happened post-Brexit, right? We wanted to turn Brexit as a necessity to a massive opportunity. And the view was to serve our European client from France. So that was our decision. So there's no plan to grow at that pace in the near future. But I think what is key here is we want to adapt and we want to evolve with our clients. So depending on our client needs, depending on the market environment as well, we will grow, to certain products, certain asset classes, and certain area. We want to make sure that we deliver the full scope of product to our clients and to offer the best services. So it's all depending on our client needs and evolve with our clients.
Okay, I have to be a little cheeky and just sort of ask, like, when you say incremental, over the next 2 to 3 years, what is incremental? Is it a couple dozen in that period or a couple hundred? What does incremental look like?
It's more than a couple dozen because already for this year we have planned to hire more than that. But again, you know, we have a big momentum here in France, a big momentum in Europe, and we want to make sure we follow that momentum. And actually, sometimes we drive the momentum. So incremental means definitely more than a dozen, and we will add, you know, over the next few years.
Well, that was Vanessa Holtz, the Chief Executive Officer of Bank of America Securities Europe, speaking at Bloomberg's New Voices event here in Paris. This is why we took the show on the road. Now, also at the event was the Chief Executive of Edmond de Rothschild, that's Ariane de Rothschild, and she told us that her firm benefited from the failure of Credit Suisse.
We manage our clients' money like we manage ours. So I think the myth of the amazingly solid bank was very harmful for the Swiss market.
So you've picked up business?
Yes. Yeah, and I think it's very interesting to see how very wealthy families have completely reviewed where they want to deposit their money.
That was the Edmond de Rothschild Chief Executive, Ariane de Rothschild. They're speaking to us at New Voices. We had a great conversation also about women in finance, which you can catch online. Now, coming up, Airbus is in talks to sell more than 100 wide-body planes to Chinese airlines. So we'll discuss that next. And this is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
demand environment, I think, remains quite robust. It's recovering slower than we had expected, principally because of the Chinese market in terms of international travel to and from China. But I think that's a timing issue, not a plateau.
We're blessed to be in a region that is growing a lot. GCC is growing a lot. I mean, Saudi Arabia is growing a lot. The UAE is growing a lot. India is growing a lot. It's just 3 hours flight, right? Yep. So it's sustainable.
Right now, in terms of engines, we do not have that problem, which the peers or the industry is facing. In terms of aircraft delivery, of course, we face some delays, but which are manageable, I have to say. I mean, it's like several weeks for that.
In the supply chain, we are having trouble sourcing parts for interior cabins, for engines, that type of thing.
We're experiencing more severe turbulence, and we haven't had a significant incident yet, but we are taking all the precautions we need to keep the safety of our customers and our crew to the maximum.
Well, those were some of the airline executives who spoke to Bloomberg at the IATA annual meeting in Dubai. So let's stay with aviation. And Bloomberg understands that Airbus is in talks to sell more than 100 wide-body jets to China. Now, talks have gained momentum since President Xi Jinping visited his French counterpart, Emmanuel Macron, last month. Now, let's get more with Bloomberg's Sid Philip in Dubai. So, Sid, good morning. Why are the Chinese carriers looking to order new wide-body jets now?
Morning, Francine. So essentially, all the airlines are looking to order wide-body jets because for all this while, we've seen a recovery of the narrow-body short-haul market. Now what we're seeing is long-haul travel is really coming back. And for that reason, airlines are really ramping up on ordering wide-body planes because during the pandemic, they stood down their fleets and now they're looking to replace them with more efficient aircraft as well as modern, more basically interiors and everything else. So we're seeing airlines ordering wide-body jets, and now the Chinese carriers are also looking at replacing some of their older jets that are coming of age and they've basically been in service for a while. And so the Chinese carriers are looking to replace those planes, and we understand that Airbus is in talks to sell them more than 100 A330neo aircraft.
So, Sid, how do geopolitical tensions actually impact the orders?
Yeah, so geopolitics obviously has a major impact on orders. I mean, Boeing is obviously trying to get into the Chinese market, but then they've also got issues with the geopolitics within the US and China. And at the moment, Boeing hasn't been able to deliver any aircraft to China because of a review by the Chinese aviation regulators into the batteries on a cockpit voice recorder. And that's sort of been a major blow for them because they just about started delivering planes again to China, and they've had to stop because of the review that's ongoing. So it is a massive blow, and essentially another bigger order for Airbus will be a blow for Boeing because they were hoping to get in more aircraft orders from China. But at the same time, Boeing's got its own bigger, wider issues, and they've got their whole supply chain issues. They've also been constrained in terms of ramping up production for the 737 MAX, as well as the production issues that they're facing on the 787. So they've got a big swath of issues they have to resolve, and this is one more issue for them.
Sid, thank you so much. As always, Sid Philip there in Dubai. Now, coming up, of course, don't miss our conversation with the Airbus and Boeing chief executives at the Berlin Aviation Summit to tune in from midday UK time. Coming up, Indian stocks tumble as early vote counts narrow than expected win for Modi.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers. It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Indian stocks, bonds, and the rupee slide as early results point to a narrower than expected win for Prime Minister Modi. Ahead of the ECB decision on Thursday, some investors are dialing back their rate cut expectations for the year on strong economic data. Plus, Intel fires back at NVIDIA over its claim that traditional processors are running out of steam in the age of artificial intelligence. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris. Now, India's markets have slid as the early vote count suggests a narrower than expected victory for Prime Minister Narendra Modi. So for more on all of this, let's go straight to Bloomberg South Asia economy editor, Rushi Bhatia. Rushi, thank you so much for the earlier update. I mean, if you look at some of the numbers as the counting continues in the next few hours, this could be a huge upset. Do we know about some of the underlying reasons why Prime Minister Modi is maybe less popular than we thought he was?
Well, absolutely right. Prime Minister Narendra Modi's ruling Bharatiya Janata Party was expecting a supermajority with almost 400 seats. In fact, the exit polls also seem to be suggesting that. But the results today, and nearly half of the votes polled have already been counted. They go on to show that it's a much tighter contest between the ruling Bharatiya Janata Party as well as the opposition-led Congress Party. In fact, while the BJP and the allies will still be getting close to the 272 mark and perhaps be forming the government, it does look like that the strategy that the opposition parties had of not contesting against each other seem to have played off. Also, remember, it is possibly because we did see local issues taking center stage. The fact that India's economy is growing at 8%, but still there is wide inequality. There is a lack of jobs. India is not creating enough jobs for its wide young population, and also the fact that high inflation seemed to have resonated with the voters, and perhaps that's the reason that we're seeing that the contest this time around is very close. It also goes on to show that the Hindu nationalist policies of the ruling dispensation perhaps have not worked in the way they wanted it to. A case in point being that Ayodhya, which centers the Ram temple, which got inaugurated earlier this year,
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Hi, I'm Laurie Haynes, CEO and co-founder of Shura, and I'm really excited to tell you that we are going to be raising funds for Shura again. After a successful raise in 2023, it's time to scale.
We hope that you enjoy the pitch deck and the financial model. Any questions, please don't hesitate to ask us, and we can't wait for you to be part of Shura.
The same, because the broader policy, he will look to focus on pushing India's growth forward. India, from the 5th largest economy, is now closely moving towards being the world's 3rd largest economy. It is firmly on the path of 6.5% to 7% growth, but can it really punch above its weight? Can it really go to that 8% level, which is necessary to create the kind of jobs that India really wants, is something that one has to watch out for. Having said that, I must also tell you that the Indian markets are not taking it very well. The Indian stocks are having their worst days since the COVID crash in 2020. After heading close to the circuit breakers, we've seen some sort of a recovery kicking in, but the Adani Group stocks today have taken a massive beating.
Rishi, thank you so much for the terrific update. Rishi Bhatia there, of course, with the very latest from India. Now let's get more market analysis with Bloomberg MLife strategist Venram. Ven, it's been quite a wild day, actually, for a lot of these assets. In India, they seem to be a little bit calmer than they were 3-4 hours ago. What do you think happens next? And good morning, Ven.
Morning, Francine. I think that this decline in stocks was perhaps in the making. We wrote about 3 weeks ago, during the election period, that look, India's markets are too richly priced, and if the news goes awry, as it seems to have now, they will face a correction, and that's what's exactly happening. And I do think that we have not reached a full stop on that selling. I think that the Sensex will tumble about at least another 3% from here to 67,000 levels. We are not there yet. A lot of it will come down to the composition of the government and the kind of coalition that the BJP has to cobble together to form a government. Now, this is a huge upset for the markets that were pricing in outright victory for the BJP and its allies. That's fallen short, so the markets have to rework that calculus. I think over the long term, it's a different story, but over the short term, India's Sensex and the rupee are pretty much vulnerable.
So then give me a sense of, if you look at some of the reforms, and Rishi was telling us about some of the land reforms, some of the labor market reform. I know looking at the Nifty bank, there's more pressure on the banks, down 7% than some of the other ones, for example, the Nifty 50 at large. What do you think is at stake? What are investors worrying about the most?
I think, a key concern for the markets, Francine, will be what happens to the infrastructure push. Will Modi's new government be able to push through with that kind of infrastructure upgrade that they were planning earlier on? If you notice, some of the biggest stocks that have fallen the most today are the infrastructure stocks led by the Adani Group. So I think that questions, those kind of questions, markets will continue to ask those questions in the coming weeks, which is why I think that, the Sensex has got a bit more to fall. And I think that it will take a long time for the markets to regroup and bid India stocks higher. And I think that will show on India's bonds as well. India's bonds, as you know, are due to be included in the emerging market, JP Morgan emerging market bond indexes. There have been huge inflows into India's bonds surrounding that. And the key question going forward will be whether those inflows keep up.
Van, when you look at some of the bond pricing, how do they compare with other emerging economies?
I think that they are pretty richly priced, and I think that there's a good reason why they are meaningfully priced, because India has just won an upgrade, ratings outlook upgrade from the S&P, so that puts it on a path towards a possible rating upgrade, sovereign rating upgrade in a couple of years, which augurs well for stocks. The Reserve Bank of India is looking to cut rates at some point this year, albeit not immediately. So that augurs well for bond valuations again. And then there are those inflows that we discussed. Those inflows are likely to continue once we know that the BJP will be able to form a viable government in the center. Once investors get past those concerns, I do think that those inflows will come back. So overall, the picture is quite rosy for bonds still.
Ven, thank you so much. Ven Ram there from our MLive team, MLive strategists there. Now, coming up, GameStop shares jumped 21% on Monday, adding some $1.7 billion to its market cap. So we'll discuss that next, and this is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Europeans are heading to the polls to decide the makeup of the EU Parliament. On the ballot, economic growth and industrial policy, migration, and the geopolitical challenges facing the bloc. Stick with Bloomberg as we bring you the latest election updates from across the continent and analysis about what it means for the region and beyond. Tune in all week for continuing coverage leading up to the election results on June 10th on Bloomberg Television. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacroix here in Paris. Now, GameStop shares surging yesterday after the Reddit account that drove the meme stock mania in 2021 posted what appeared to be a $116 million position in the video game retailer. Now, the screenshot posted by Keith Gill showed a stake of 5 million shares. So let's bring in Bloomberg's Charlie Wells. Charlie, this is such a crazy story. Can the factors that propelled this week's GameStop rally keep going?
That's a really great question. I mean, look, this is certainly not 2021. The economic situation that brought the likes of meme stocks like GameStop, like AMC, are very different. But what I'm thinking of with this week's rally in GameStop is back to last month when Keith Gill, instead of taking to Reddit like he did this month, took to X to post a very cryptic message that looked like he was getting involved here. And that, again, translates back to this Reddit post where we saw this large position in GameStop. We saw also 120,000 call options here. Now, this is, propelling this rally, at least as of yesterday, but not a lot of fundamental changes at this company. So the meme rally, whether or not that continues, this phenomenon of social media investing, certainly here to stay.
So recent reports, Charlie, also show that E-Trade is considering kicking Keith Gill off its platform, at least according to the Wall Street Journal. What do we know about that?
This was a striking story. People familiar with the matter saying that inside E-Trade, which is of course owned by Morgan Stanley, people last month saw the account of Keith Gill make a large volume of options purchases before that tweet that I was talking about, before that tweet that drove that market rally. Now, the concern here is that this is market manipulation, and what we know is that no decision at E-Trade has been made about whether or not to kick Roaring Kitty, as he's also known, off of the platform. We know that the SEC is looking into market manipulation regarding GameStop, but there is a flip side to this, and the flip side is, a lot of these communications are vague. There's questions about whether this truly is market manipulation, but also if you kick someone with this sort of influence off a platform, you bring that army of retail traders potentially following and potentially leaving a platform like E-Trade as well.
Charlie, thanks so much. Charlie Wells there with the very latest on GameStop and other meme stocks. Now, Intel Chief Executive Pat Gelsinger has hit back at NVIDIA in the battle for the AI chip leadership. Gelsinger says NVIDIA boss Jensen Huang is wrong about traditional processors running out of steam in the age of artificial intelligence.
We look now to have 1 billion transistors on a single chip, and even looking to 1 trillion transistors in a single package by the end of the decade. And unlike what Jensen might have you believe, Moore's Law is alive and well.
Well, let's bring in Matt Bloxham from Bloomberg Intelligence. Matt, good morning. So does Intel have actually what it takes to challenge NVIDIA on AI chips?
It's a good question. I think it's going to be a really interesting rivalry that unfolds over the next couple of years. I think if you think about NVIDIA's dominance in AI chips, it's around the data center, and its biggest customers by far are these big so-called hyperscalers, people like Google that run the big data centers. Now, obviously, the growth opportunity for generative AI is around enterprise use of that. NVIDIA's talked about that a lot as a kind of incremental revenue opportunity. This is clearly where Intel has historical strength, both in terms of kind of processing, but also the server market. So I think it's going to be a real kind of clash of chip titans, if you like, going into the next 2 or 3 years. And obviously Intel's pushing this as a combination of being faster and cheaper. So they're kind of matching their new Gaudi processors up against the NVIDIA H100s, which is the current generation of NVIDIA chips, soon to be replaced by their Blackwell chip. So they're kind of going for the look. If you're thinking about the H100 from an NVIDIA, then this new Intel processor is going to give you better performance at a substantially cheaper price. So they're talking about maybe up to 2/3 less of the cost of an equivalent NVIDIA platform. So it's going to be an interesting time to watch how this evolves.
So, Matt, give me a sense of what happens in 12 months, 15 months, 18 months. How do you see this rivalry evolving?
Yes, obviously right now the focus is on these kind of data center AI chips, but the rivalry is probably going to shift towards the PC market too. Now, it's obviously where Intel has a lot of historical dominance, but there's been rumors for quite some time that NVIDIA is exploring the opportunity to develop its own AI chips those rumours have been growing louder and louder in recent weeks. Even companies like Dell that partner with NVIDIA suggesting that NVIDIA could be getting into that market. Some stories over the last week providing more clarity about what that kind of chip proposition might look like. So I think clearly over the next 12 to 24 months, the data center AI processing driver is going to heat up, but then we're going to get this extra dynamic in the AI PC market probably in 2025. So NVIDIA is protecting its space, developing its technology, and part of that is the defense saying, if you enter to Intel, if you enter my space, I'm going to push back into your space too. So you're going to have a really interesting, multifaceted rivalry, I think, in the next 2 to 3 years.
Matt, thank you so much, as always, for joining us. Matthew Bloxham there from Bloomberg Intelligence. Now, coming up, we talk about the UK and the UK Prime Minister Rishi Sunak being dealt another blow as Brexit architect Nigel Farage says he will stand in the general election. That story is next, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacroix here in Paris, where we were here for the New Voices program. Now, onto politics, and the Conservative and Labour leaders will go head-to-head in the first TV debate of the election this evening. But whoever wins the vote on July the 4th will be saddled with an economy laden with debt after 4 years of crisis spending. Well, Bloomberg's Alice Morgan explains.
The photo ops are in full swing as the UK general election kicks up a gear. But whoever wins that contest will face a harsh truth. The UK has a massive debt hangover, and that threatens to tie the hands of the next government and to collide with spending pledges on things like defence, healthcare and education. The UK spent big during 4 years of crises, from COVID to the energy price spike following Russia's invasion of Ukraine. Government support measures during those successive disasters cost around £400 billion. Both parties supported taking a generous approach. Now, though, the bill has come due, with national debt at a level not seen since the 1960s. Servicing that debt in a world of high interest rates is costing an extra £60 billion a year. To put that in perspective, that's equivalent to the entire defence budget without a bullet to show for it. And now, creaking public services are crying out for more funding, with much desired economic growth seeming elusive.
Well, the election debate so far has really been focused on how the parties are funding relatively small pledges on taxes and spending. But this misses the far bigger picture of an unprecedented peacetime rise in debt, rising taxes. What's really happened here is that the fiscal debate has got detached from that fiscal reality.
Rishi Sunak claims the economy has turned a corner, with inflation falling back near the 2% target.
Thank you.
Meanwhile, Labour are on a mission to assure business that they are the party of economic stability. Regardless, the UK faces a mounting bill with no easy way to pay it off.
Now, staying with the UK election, Brexit cheerleader and populist Nigel Farage says he will run for Parliament days after ruling himself out. Now, he'll stand as a candidate for the Reform UK party, as well as taking over its leader. Well, joining us now is Bloomberg's Ellen Milligan. Ellen, good morning. So why is Nigel Farage's return so critical for the Conservatives?
Well, as Nigel Farage himself said yesterday in his so-called emergency press conference, he wants to lead a political revolt this election and afterwards. So he's running in a seat in Essex, and this is all about squeezing the Conservatives. So from the left, you've got the Labour Party, and now from the right, you've got Reform led by Nigel Farage. Clacton in Essex was a seat that was won by Farage's old party, UKIP, in 2015, so it's winnable. But it's also about influencing Conservative Party policy and swinging them to the right. So, for example, hours after Farage announced he was standing, Rishi Sunak announced that he would place a cap on immigration visas, for example. So you're already seeing the effect that Farage is having.
So, Ellen, the Prime Minister Sunak is attempting to open this clear divide with Keir Starmer on immigration. So what exactly is he pledging?
Yeah, well, he's announced that he wants to introduce an immigration cap. He hasn't put a number on it. Labour Party, Keir Starmer, has announced that he wants to reduce immigration. Again, hasn't put a number on it. So I think at the TV debates tonight, you'll really see them going at each other on their kind of quite thin immigration policies. But also my colleague Alex Wickham reported today that the Conservative Party is considering a more hardline position on the European Convention of Human Rights. This is the court that's involved in the Rwanda bill, for example, that the right-wing Conservative Party complains is disrupting UK legislation. So I think that will be really interesting if that's created as a dividing line also.
Ellen, thank you so much. Ellen Milligan there with the very latest on the UK. Now, I have had a couple of traders actually email and get in touch saying what we've seen and the upset that we've seen in India with the fact that Modi's coalition has a narrower, for the moment, as votes keep on being counted, a narrower than expected lead. What does that mean for the UK? Because yesterday we also had mega polls that were published in the UK that had Labour actually winning by at least 20 points. So there is a little bit of question mark whether some of the polls, and again, the parallels between India and the UK system are very different, but there are a couple of questions on the market about what it means. Now, because of this narrower than expected, of course, lead by Narendra Modi, you can see the MSCI India Index down 6%. Up next, Bloomberg Brief with Manus Cranny in New York. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Good morning from our global headquarters in New York. I'm Manus Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Treasury steady after data shows the U.S. output is near stagnation, pushing 10-year yields to the lowest in over 2 weeks. Join the race. Intel hops on the latest run of AI product announcements, hoping to turn back the tide of losses. And Indian stocks head for the biggest intraday drop in more than 4 years as Prime Minister Modi's party inches towards a victory. A very good morning to you. These stock markets are heading for a summer of inconsistency. We're being dragged lower mainly by the oil markets. You're looking at the dollar index up by 1/8%. Intel rises by 1%. Pat Gelsinger gets on the stage and basically challenges Jensen Huang. 10-year yields, you're looking at a small moment of steadying the nerves. We dropped by 11 basis points yesterday. Manufacturing stagnated at a 3-month low. Now, bad news is bad news. That certainly seems to be the sense in this market. Clock Tower, Marco Papic over there talks about the disaster for the bond market if there is a Trump sweep, and that is a probability that they are raising. The dollar, we'll talk more about that with Dara Maher. It's up by 1/8% despite the crushing blow in the short end of the curve yesterday, down by 6 basis points, not as much as the 10-year or indeed the 30-year part of the market. So we'll keep an eye on the short end of the curve. We're counting down to a little bit more data today. Well, it was after that weak data that reinforced the bets that the Fed will cut rates at least once this year. Yields hit the lowest in more than a week, as I said, and investors look forward to the JOLTS data later today. And the crescendo for data is, of course, Friday with the jobs report. Joining me now is Dara Maher, head of HSBC Research for the Americas, and this is what he says. There would need to be a meaningful disappointment this week to see the Fed rate cut expectations pulled earlier and to discount a bigger magnitude thereof. The bar is high. Dara, good morning.
Morning. How are you?
So I'm good. Yesterday was a bit of a jolt. It was stagnation in the data. The yields dropped by 10 basis points. Further out the curve, I put it to you. But we've pulled forward the possibility of a rate cut to September. It's a 50-50 coin toss. Is the bar suddenly being challenged now in terms of the rates market and the thinking?
Yeah, look, I said the bar was high and the market jumped, so there you go. What can you do? I just find it all a bit weird. I mean, a couple of weeks ago, we were talking about U.S. sticky inflation, economies that are running hot. We have a couple of data prints out of the U.S. and suddenly the economy is stagnating, rolling over, and we should panic and run for the hills.
You're skeptical, though, of that.
Well, I just don't think things move that quickly. I think the market is... What's the big picture in the U.S. economy?
Right.
The big picture in the U.S. economy, inflation is stickier, I think, than the Fed had anticipated. We've held again a 2.8% in core PCE deflator. The economy is slowing, but that's for the Fed. That's why you raise rates. That's why you have restrictive policy. So the danger is the market, of course, take a data point and extrapolate it all the way forward. And I think that's maybe what they've done yesterday with that data point.
What concerns me when I look at moves in the bond market, like I saw yesterday, at one stage yesterday afternoon I was doing prep for this, 30-year paper was down 11 basis points. The belly of the curve was down 9 basis points. But yet I looked at the dollar and the reaction function, and the dollar was not as aggressive as it was in the rates market.
Yeah.
What is liquidity like?
It's reasonable. I would say there's not much conviction out there. People say, look, what are your clients saying about the dollar? And I think the answer, they're not saying a great deal, frankly. I got into a trade to sell euro dollar 3 weeks ago at 108.80. I think we're trading 108.80 this morning. It has been a yawn fest. And this is the challenge, particularly for currency investors, is what is the next big thing that gets us trending in this market? And it's been a struggle to find. For the bond market, last week, we were doing headlines about how awful everything was, these soft auctions, nobody wants to own U.S. Treasuries. This morning we're running with headlines with everyone wants to own U.S. Treasuries, and look at the massive drop in yields yesterday. Again, markets struggling forward direction.
You start with the thesis that the dollar fatigue but maintains conditions for a sustained weakness are not there. So it's going to take an awful lot more for you to sell the dollar against the crosses.
Yeah, I think so. Look, this is a high-yielding currency. It's the world's preeminent risk-free currency. The analogy we used was running the marathon, which, of course, I've never come close to doing. So
you're all right. I'm not there with you.
I had to point to my daughter. And you do hit the wall, and, at some point, it doesn't mean you don't move forward. It just makes that momentum much harder to sustain. I think that's where the dollar is. I think the distinction you have to make is, do you think the dollar will strengthen further, or does it remain strong? And obviously there's a nuance there in the language. In other words, we think it holds on to its gains, but it's not going to knock it out of the park, as they say over here, in terms of additional strength, because it does face headwinds at these levels.
One of those headwinds, and Marco Pepic over at Clock Tower wrote about this yesterday, was the risk. You've all got to now start strategizing for the risk for a Trump victory, a Trump sweep. And as he said, that would be, fiscally, it would be a huge challenge here in the United States of America for the bond market. He evokes, profligacy on the fiscal side. Are you beginning to model not just a Trump victory, but a GOP sweep? And what would that do, in your thinking at HSBC, to the dollar?
Yeah, look, I think currency market, so the short answer is yes, we are. The complicated answer is it's not clear actually what that would mean. Currency markets, you've been around them for a while, Manus, they love to oversimplify. They want to be able to say a Trump clean sweep equals dollar up, or, there has to be that binary outcome. It's never going to be that simple. Yes, we have a fiscal angle. What about Fed independence? What would a Trump clean sweep mean for Fed independence? What does it mean for the geopolitical backdrop? What does it mean for trade policy?
But do you think that the market will begin, it will classically begin to take some option positions on to cover themselves? Maybe not outright flow in dollar, but you'll begin to see the various skews begin to heat up.
I think the simplest reflex is people will assume a Trump and a clean sweep for the Republican Party would be dollar bullish, for business friendly. Right. We're off to the races again on fiscal policy. But we also have to remember all those other counter arguments. And I think, for one, fiscal policy, what would actually a fiscal stimulus from this starting point in the US mean for the US dollar? Would it be a big yield story that supports it? Or would it be a structural story that undermines it? And again, that's why I think it's much more complicated than this Trump equals dollar up. I just don't think we're there.
Okay, you want to make it more difficult for me. We've got a few things to pack away. Suzuki confirms intervention of $62.7 billion. I saw one lovely line. It's just too easy to be, it's still easy to be short the yen. It is still the funding currency. Yeah. It's still a carry trade. With that amount of intervention, they're supposed to go limited and well-warned, according to Yellen, and be judicious in this. But it's becoming more often and in size. This is still throwing peanuts at the intervention gallery.
Okay, so let me stand up for them, because...
You go right ahead. Go on.
Where would we be if they weren't? I mean, where would we be if they hadn't been talking intervention for the last X number of months, and if they hadn't actually deployed some cash to back it up? We could be at, I don't know, make up a number. So... has it been effective? I would say yes, it has been effective. It's introduced two-way risk into a market that would have happily run away with itself. Do you turn it? No, but that might not be their measure of success.
They could term a measure of success a cap.
Exactly. So to that extent, they might be reasonably happy, but you are fighting this massive carry gap. It's narrowing, but it's still very generous. Everyone loves to get paid for doing nothing, and you get paid for holding dollar yen. So you're getting paid for doing nothing. I'll happily take that job.
You've got where are you? You're long euro dollar at 108. Where are we?
No, I'm short euro dollar.
You're short euro dollar at 108.76. So I suppose you've accepted that you're going to get your 25 basis point cut now. But what are you praying for? Consecutive cuts? Because the language around consecutive cuts is changing. Nagel, Schnabel, they're all sort of mounting the attack back against assuming that you're going to get multiple cuts.
Yeah. What I'm praying for is more stories like on Bloomberg this morning, offering exactly that narrative that we're not going to get consecutive cuts, because
you're trying to skew the spike. You skew
let's get into the meeting,
spike.
where everyone positioned the wrong way. Look, I think you've got 2 basis points or so priced in for a July move, so 1 in 10 chance, let's call it.
Yeah.
If we get anything from Lagarde that says July's live, I mean, not, let's say, a more probable than not, but in any way live as a meeting, the market has to reprice that, even if it's 5 basis points or 8 basis points, blah, blah, blah. So I think I'm pretty comfortable going to the ECB that side, particularly as you guys keep on telling me I'm wrong. So that just makes me happier.
We merely present two sides of the argument. To be fair, wages are hot. 4 big economies coming out of recession.
Well, these are lagging. Wages, you're getting wage growth based on what inflation was last year.
Darren's here with the counterfactual and the argument. He's got counterfactual and he's got argument.
My book. I'm talking
It's all right.
Book.
It's absolutely fine. We'll let you do that. At least you're honest and you're declaring your position. Darren, good to see you this morning, setting the tone. Darren Maher of HSBC, my guest on the markets. Other stories trending on your Bloomberg terminal this morning. What have we got for you? Airbus is in talks to sell more than 100 wide-body jets to China. The talks have gained momentum since President Xi Jinping visited France and met his French counterpart, Emmanuel Macron. That was last month. The terms are still being discussed, and the timing of the deal is somewhat uncertain. Maersk has raised its full-year profit forecast. The shipping giant says the congestion in the Red Sea is having a larger than previously expected impact on the world's supply lines, which in turn are boosting freight rates. Skydance plans to offer $23 a share to investors in Paramount voting stock. Now, this is said to be part of the plan to merge with the firm and the TV giant. The bid would be made to investors other than members of the Redstone family, which holds most of that voting stock. Coming up, Intel's Gelsinger fires back at NVIDIA's Huang in the battle for AI chip leadership. More on the story. That's next. And we speak to Henrietta Bacamont of Allspring Global Investors on why U.S. growth exceptionalism is starting to show cracks in the armor. Context matters on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt.
That's why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
Look now to have 1 billion transistors on a single chip, and even looking to 1 trillion transistors in a single package by the end of the decade. And unlike what Jensen might have you believe, Moore's Law is alive and well.
The Intel CEO, Pat Gelsinger, they're firing back at NVIDIA's Jensen Huang as the chip giants unveiled the new processors and made a heated AI chip race. For more, Matt Bloxham joins me from Bloomberg Intelligence. It was like the rock stars of the chip world sort of fighting it out. Gelsinger has a lot more to convince the world of, doesn't he? His stock is down 39%. His chip business is not exactly firing on all cylinders. What do you make of the bravado? Good morning.
Yeah, hi there. So the key message from them is this faster, cheaper, and more accessible with this new Gaudi chips. You know, we're very familiar now with the Hopper, which is the NVIDIA AI chip, and Intel comes in with the Gaudi 2 and 3. You know, it's really interesting that they're talking about these kind of big performance advantages over equivalent NVIDIA chips and being substantially cheaper, as much as a third of the cost of an equivalent NVIDIA setup. So I think they're making a really big push. And I think the interesting dynamic is here is that so far, a huge amount of demand for these AI chips has been from the so-called hyperscalers, so the Googles, the Microsofts, well, the big kind of cloud platform providers. But the expectation, and NVIDIA's been talking to this too, is that the future demand is going to come more from the enterprise market. Now, historically, that's clearly where Intel has had a much stronger position, so that timing-wise, it makes sense that they're coming out with this now, and the pitch is very much to those enterprise clients that are looking for a combination of performance and return on investment, and obviously a lot of those enterprises are already using Intel-based server architecture, so there is definitely an opportunity for them there, but it's going to be a difficult slog, I think, to kind of really convince a huge amount of customers to kind of shift allegiance, if you like, from the NVIDIA platform, but that they have to be in there. They don't really have any choice other than to try to grab a share of this really important market for the future of technology.
Well, maybe that will ultimately come down to pricing. Look at the margins that NVIDIA has relative to the pricing in the market. Ultimately, price and delivery will be sort of traded off. We've seen it time and time again, a commoditization of a high value, high premium product, especially in the tech space. Let's pivot to Apple. I mean, we're back in the black for Apple for this year. So again, all the skepticism around Apple seems to be incrementally being undone. What is it that shifted the narrative for Apple?
Do you know, I think part of it earlier this year, there was a lot of clouds over how they were performing in China, which is kind of 15 to 20% of their sales. Actually, they surprised the market in how resilient that was being. I think then the news has been more positive. Obviously, they gave us a teaser a few weeks back about what they're doing on their own AI strategy. And I think people are looking forward to this big event in the next week or two, the Worldwide Developer Conference, which is where they'll really lay out in more detail the substance of their AI strategy. And, we're kind of seeing a shift, and we heard it again yesterday with Intel about this, the importance of the AI PC. I think we're going to see that AI smartphone become really important too, and obviously with the launch of the next generation iPhone coming up probably in September, I think this big event in the next week or two that Apple's hosting will give us some signposts to that. I think it maybe is an opportunity for Apple to kind of reignite some excitement about creating or evolving that core product category for them and kickstarting revenue growth again for them in that space, which is iPhones are over 50% of the revenue. So it's really important for the kind of outlook for Apple to kind of give a good sense that that's a growing category.
Okay. And certainly, if you look at what Wedbush is saying, it's this next movement, the iPhone 16 super cycle, and how that is going to be monetized from the AI perspective. Matt, thank you so much for joining us on the Tech Stories this morning. Bloomberg Intelligence, keeping it real. From Silicon Valley to Wall Street. So we had a glitch during a software update early yesterday. That led the New York Stock Exchange to erroneously hold trading on about 40 stocks, even displaying trades showing 99% drop in some companies, including Warren Buffett's Berkshire Hathaway. Let's talk to Charlie Wells about the glitch and the case for reverting back to the old software, or is everything fine? Innovation costs, doesn't it, Charlie? What do the NYSE have to say?
Yeah, look, so they said that this was related to a glitch tied to software that controls limit up, limit down halts. Now, that is a little bit ironic because those limit up, limit down halts are supposed to protect investors in the event of volatility. That's not what we saw yesterday morning when we saw a lot of volatility in the New York Stock Exchange. I think something that really stuck out from yesterday was Class A shares of Berkshire Hathaway being offered, it looked like, for a 99% discount. Now, the New York Stock Exchange has said that it has resolved those issues. It resolved those early in the day yesterday, and those trades that were made based on that odd pricing are going to be canceled. But this is an issue, and putting this into context, a lot of people have really been holding their breath since that transition to T+1 settlement, right? That is speeding up trading, and I think there had been a lot of concern about what could happen. Yesterday, there were questions about whether this glitch was tied to that. It seemed like it was just bad timing, but of course, it's been bad timing for the past week, where there have been 3 incidents in U.S. markets that have interrupted trading in this manner.
Could you imagine the anaphylactic shock you'd have if you had Berkshire Hathaway and you opened up your portfolio reval 0? I mean, that's pretty nightmarish. Listen, and good to hear all those trades have been busted, all the stop losses that would have been triggered. I can remember well when that happens. Talk to me about how you choose to have as your client. We understand from the Wall Street Journal that GameStop evangelist Keith Gill is reportedly at risk of being kicked off E-Trade. Now, this is the electronic trading platform. Is Roaring Kitty having his claws clipped?
Great question. I think if you're going to try to clip a cat's claws, you've got to be ready for some of the risk as well. And look, this gets to the issue of market manipulation and meme stocks. So we saw yesterday a rally in GameStop, and that was on the back of a Reddit post by Keith Gill. He returned to the Reddit platform for the first time in a long time yesterday, but this calls to mind what happened in May when Gill posted on X a post that sent the shares surging. But of course, he uses the E-Trade platform, and people familiar with the matter told the Wall Street Journal that they saw Gill make large options purchases before that tweet, and some of those options expired that very week. And so there are questions about whether this was market manipulation. We know the SEC is looking into this regarding GameStop, but I was talking about a potential backlash, and that potential backlash is that army of Gill supporters leaving E-Trade potentially if Gill is kicked off.
Okay, Charlie, thank you so much. That is Charlie Wells on the very latest with GameStop and Keith Gill. Some breaking news for you from the Bank of Japan. We've just been talking to Darren Maher about the Bank of Japan's action in the currency markets. This is in the bond markets. It's said to be mulling reducing its bond buys as early as the June meeting. They're going to watch markets till the very last moment before they decide. Is said to have no intention to surprise bond traders. So again, this is about adjusting both in terms of intervention in the FX side and in terms of their participation in the bond market. Now, there is dollar yen 155.16. We just had that conversation with Dara. We had the confirmation by Suzuki that there had been intervention in the dollar yen market of over $62 billion. And the counterfactual is, of course, as Dara said to me, well, if they hadn't intervened, where would dollar yen be now? More to come on Bloomberg. Good morning.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Indian assets under pressure this morning as Narendra Modi BJP party looks as if it may not get the 272 seats it needs on its own, but may well have to do an alliance. You're looking at the Nifty, the biggest one-day drop in 4 years, and of course the dollar bid against the rupee. Volatility's up.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Global headquarters in New York. I'm Manus Cranny. Let's set your agenda. Treasury steady after data shows the U.S. output nearing stagnation, pushing 10-year yields to the lowest in over 2 weeks. Join the race. Intel hops on the latest run of AI product announcements, hoping to turn back the tide of losses. And Indian stocks head for their biggest intraday drop in over 4 years, as Prime Minister Modi's party inches towards a win. So bad news is bad news. That's certainly the conclusion by the market. We are grappling with a stagnation, or that's the tone from the PMIs yesterday. But do bear in mind, you have had the third best run from January through to the end of May since the year 2000. You're going to go into a summer of inconsistency, according to JP Morgan. Stocks are lower this morning. We saw oils taken down in the European session. Look at that oil market. Brent getting crushed for a fifth day in a row. We lost 3% in value yesterday. The Bears are very firmly in charge. By the way, Joe Biden will be refilling the SPR with 3 million barrels today. So this drop in price in oil is certainly a boon for the Biden administration. 10-year government bonds are flat at the moment, 439. Do bear in mind, we dropped by 11 basis points yesterday. Manufacturing now, the narrative is around stagnation nation in the United States of America. It's amazing how quickly we vault, obviously, from sticky inflation and soft landing to perhaps something a little bit more challenging. Clock Tower had a big piece out yesterday talking about a disaster for the bond market if there was a Trump victory and a sweep. Fiscal profligacy is what Moko Papic is talking about yesterday, and that's certainly permeating through the minds of the bond traders. Well, treasuries remain steady. Investors are weighing their concern about the health, the robustness of this economy, and stronger expectations for an earlier Fed policy move. September is now 50-50 in the minds of the swaps traders. Let's get to our Bloomberg macro strategist, Simon White. How quickly the narrative changes. That's what Dara Maher was just saying to me there 10 minutes ago. Last week we were talking about really sticky, enduring inflation, higher for longer. One print on the ISM and this bond market really did convulse yesterday. Are we going to now hear narratives around stagflation? Good morning, Simon.
Good morning. Yeah, I think it's a bit of an inflection point. I think we've went from a period where, essentially you had low recession probability, and it would take quite a lot to shift the dial to suddenly it becoming a much higher recession probability. But now, it's like an S curve, if you like. So we're now at the point where the gradient is potentially going to become steeper, and therefore it wouldn't take much to in terms of the data to suddenly you're in a situation where recession has gone from like a 2 or 3% probability to maybe like a 70 or 80% probability. And that means it's a lot for the market to digest. So where yields are right now, you know, they're trying to kind of factor in that potential change in recession likelihood.
I mean, if we go from the narrative of soft landing, no landing, to something much more aggressive, what does that do to the bond market? Because this bond market has been hovering around the 4.5s for quite some time, and this could be the catapult that it needs, I suppose, to emboss the HSBC narrative of lower yield.
Yeah, I mean, I've looked at a lot of the positioning metrics, so you can infer positioning where hedge funds are positioned, where CTAs are maybe positioned, and I think positioning has become a lot more neutral. So therefore, people are ready to, you know, maybe take the next trend. So I think 4.5% has been a bit of an anchor point. You can try and sort of ascertain what you think is quote-unquote fair value for bonds based on things like the Fed rate and the yield curve. And 4.5% is roughly there or thereabouts, which means that we're looking for the next kind of push, which direction it's going to be, with positions being much clearer as they are. So if we're going into this period where, you know, the data is going to start to weaken, and as I say, you've got recession risk rising, which doesn't mean a recession is definitely going to happen. It just means people are going to have to be thinking about it a lot more. And if that's the case, then yields are going to want to reflect that, you know, because you're going to have the possibility that more likely that the Fed will be looking at cutting rates again. So I would say for the, you know, the interim period, probably over the next few months, you're looking at lower yields. But I think the broader picture is still there's an inflation problem.
Yes.
And so I think the bigger picture is inflation will start to rear its head again, and yields will reflect that. And that might be a later in the year story.
Okay, Simon, thank you very much. That is Simon White. We're counting down to the JOLTS data today, along with the services data, the ISM services data, on all the way through to the jobs report. Don't forget jobless claims on Thursday, and non-farm payrolls, 185,000 is the survey consensus. My guest this morning, to make sense of it, better sense than I will, is Henrietta Buckhamall, head of global fixed income at Allspring. Henrietta, great to see you. Listening to Simon there, it's amazing, and to HSBC a little bit earlier, how quickly we flip-flop from sticky, higher for longer inflation last week. Today, we're talking about a 50-50 coin toss that September is live. How quickly can this bond market begin to move towards a harder landing narrative?
Well, it's really interesting because last time I was on the show, we talked about some of the US data really taking a little bit of a turn for the worst. So I think what we've seen over the last few days is a bit more of that. So not necessarily a surprise, and you know, explains why we do like the bond market at this point. And we still think that we're in this situation where the inflation aspect and the growth aspect are going to fight it out over the next few months. So it makes sense to sort of see that volatility at this point.
And it's healthy volatility for anybody that's trading bonds out there. A bit unnerving for you if you've jumped in and gone long duration and went, hurrah, 4.5%. Actually, you're making money. You're trading at 4.39 at the moment. So maybe duration hunters that jumped in are doing quite nicely. Here's the thing, though. Do you think stagflation is a narrative that will rise again? I mean, we go through these narratives, don't we? Soft landing, no landing. I just get the sense now that we're probably going to start talking more about stagflation if we get a softer JOLTS and if we get something irksome on Friday in the jobs report.
Yes, you know, we're looking for a theme at the moment. You know, inflation is still proving to be a little sticky. I mean, there are three aspects that we look at for the inflation story. It's the level, it's the breadth, and it's the stickiness. So I think, you know, level is still arguably a little high. Breadth is looking better from our perspective, and there is still a bit of stickiness around. So the inflation story has not gone away, so that explains the talk of stagflation. I think what's a little different is the growth story, particularly on the US. So yes, at this point, we're looking at the sort of growth numbers, and we're keeping check on the inflation side to make sure that we still get a tick down, or at least not a worsening of that aspect.
So we spent quite a bit of time talking about the yield differential between the States and Europe, and now we're going to talk about a growth differential between the US and Europe, which of course makes the ECB's job all the more challenging. I look at CPI 2.6%, wages 4.7%. I'm curious to get your view, because everybody's batting away the wages and batting away the fact that 4 of the top economies in Europe have averted, they've come out of recession or averted recession. How much harder does that make to the cadence of rate cuts that is assumed by the market and probably priced in at the moment for the ECB?
So obviously we're going to get a cut this week. That's very much expected. The question is what comes next. Yes, we've seen a bit of a repricing there. At this point, we probably think that July is out instead in terms of a further rate cut. So the ECB is going to cut and then have a look and see how the data pans out. Growth is better, and we've seen some green shoots there, but it's not extraordinary. So I don't think that necessarily is something that's an issue there. Yes, the question mark remains on inflation, and a bit like the US, not at the same level, obviously. We need to keep an eye on that, and wages are a component of that. From our perspective, the sort of pressures in Europe at this point are less than in the US, which explains more cuts in Europe that are priced in at this point compared to the US.
What does that do for credit? I'm looking at your credit perspective at the moment. Lower credit quality has had a better performance given the levels that we've reached. We tread carefully in the lower credit spectrum. I just wonder, is that the same for Europe as it is for the US? If I'm getting better and more robust growth numbers from Europe and possibly a sequence of cuts in Europe, does that begin to underpin credit in Europe relative to the US trade?
Well, it has already. I think we've seen the credit markets really price in a benign environment from a growth perspective in the US and more likely rate cuts in Europe. So slightly different drivers there. But we have got an environment across the spectrum which is pricing in a not a bad environment for credit at this point.
So I'm sort of quite drawn by this Clock Tower piece that was written yesterday. It's by Marco Papic. Talks about the probability of a Trump victory. That's, it's hard to call, but they say a Trump victory upgraded to 60%. But I'm drawn to the language that Marco uses. Bonds will start pricing in a higher level of fiscal profligacy. They see a Trump victory as an epic disaster for bonds. Now, of course, you reflect back to 2016. I know bond prices are at a different level to where we were in 2016. I know the reaction function may well be different to 2016. People are throwing tomatoes at the screen right now at me. But, I mean, this is quite rich language, and that's what I'm drawn to it. Do you have a concern that the bond markets will have a touch of anaphylactic shock on a Trump victory?
Well, it's a really interesting one. I would say that the US has been pretty generous from a fiscal perspective already. And I think our stance is, whether you get Biden or whether you get Trump, yes, you are going to be in this sort of looser fiscal environment that we're currently seeing in the US, and partly explains the sort of US growth exceptionalism that we had earlier in the year and in 2023. So for us, it's more of a continuation of what we're seeing now. Probably how it's going to affect the markets is going to be different. Biden has been more on the sort of spending side. On the Trump side, it may be more related to the tax element. So yes, our stance is that we're going to have a generous US from a fiscal perspective going forwards.
But let's hope that the bond markets don't mind hope they can bank on the generosity of strangers. Well, we know who most of them are, but I think you know what I mean. Henrietta, great to see you this morning. Let's count down to that ECB and the tonality and the intonation from Madame Lagarde. Henrietta Bacamont at Allspring. Her calls on the markets. Coming up, not so nifty. Indian stocks tumble as the early vote count points to narrower than expected win for Narendra Modi. You're looking at the Nifty there, one of the worst days on the Nifty in over 4 years. Volatility is spiking by 42%. It looks like Modi is going to struggle to get this absolute majority for his own party without working in tandem with his allies. We're live to Delhi for the latest. Context matters on Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg Brief. I'm Manus Cranny in New York. A very good morning to you. India's stock market is set for the biggest drop since March 2020. We've got a tight election battle. Prime Minister Modi. Let's get a little bit more from our Bloomberg reporter, Ruchi Bhatia, joining me now from New Delhi. Ruchi, the markets are literally convulsing. Stocks, bonds, really taking it badly. That this super majority that they presumed that Modi would get simply is not coming to pass. I mean, just update us. I mean, we're looking at convulsion in the equity market. What is the major consequence if he doesn't get the supermajority as presumed?
Well, as we speak, Manus, the Indian markets have stabilized a bit, but having said that, the stocks are still having their worst days since the COVID pandemic in 2020. The expectation was that Prime Minister Narendra Modi will come with a supermajority, and that would mean that he will have the mandate to push through some of the critical reforms, some of the hard structural reforms like land, labor, farm sector, etc. But looks like domestic compulsions are going to, take much of his time, because he and his ruling Bharatiya Janata Party have not been able to cobble up the majority mark of 272 out of the 543 seats. We're way past the halfway mark in terms of the counting. Nearly half the votes have already been counted, but the Bharatiya Janata Party is still short of the majority by itself, which means that the opposition parties will be pretty strong. He will need his allies to push through some of the critical reforms, which will mean some sort of a delay in decision making as well.
Yeah, I mean, look, we're seeing this reflected in those close companies to Modi, the Adani family companies, Adani Ports, Adani Industries, all really taking this hit in terms of the political allegiance. But from where we sit in New York, obviously, there's a huge exposure for companies like Apple, the FDI story, the onshoring story in India. How might this political nuance impact American corporates?
So you're right. The Adani company stocks have lost almost about $40 billion in market value today. However, on the other side, we are seeing some of the consumption stocks doing well. Having said that, as far as the broader policies are concerned, because it does look like the ruling Bharatiya Janata Party and with allies will be able to form the government. As far as the broad macroeconomic policies are concerned, they will still remain on track. A lot of good things have been built into the system. For example, the kind of spending that we've seen on infrastructure. But as far as crucial reforms are concerned, like land, labor, farm sector, etc., the government will find it hard to push through these reforms because these reforms are critical for them to be able to get the supply chains to India, to get the manufacturing firms to come and set up their base in India. India is already in talks with the likes of Tesla, for example, and how the existing dispensation, the new government will be able to woo companies like China, one will have to wait and watch out for. Also, I must also mention that India was also seen as a counterbalance to China of sorts. So how will those policies play out, and whether India will continue to remain as assertive on the global stage or not is something that we will have to watch out for. India wants a seat at the table. Whether it will be as assertive as it was in the past is something that we will have to wait and watch out for.
Richie, certainly there is a tough time in the equity market this morning. We're just showing a whole cast of losses there across the equity market. Richie, thank you so much for being with us, Richie Bhatia. A glitch. There was a glitch in the software. There was an update on Monday in the New York Stock Exchange, and it erroneously halted the trade on about 40 stocks. Here for a little bit more context, Charlie Wells joins me. Look, Charlie, there's going to be lots of people screaming from the rooftops going, go back to the old software. They have this update. We've got one-day settlement. What has NYSE actually said?
They have said that this was a glitch that was tied to some limit up, limit down processes. But look, I think there's going to be a lot of fingers pointed, but some of the more dovish analysts that we talked to yesterday indicated that, look, maybe we're spoiled. Maybe we're used to a lot of uptime, and as you upgrade this technology, there's going to be some kinks.
Yeah, and I mean, when you open your portfolio and you see that Berkshire Hathaway is down 99%, you just got to hope that your broker didn't have a stop loss in there and the undoing of all of that carnage. Talk to me about Keith Gill. I mean, he's the evangelist of GameStop. Now, we got reports that he may be kicked off E-Trade. What do they not like about him? Do they think that he's maybe having his roaring kitty, possibly having his claws clipped?
So people familiar with the matter told the Wall Street Journal in a report that employees have been looking at some of the large options that Keith Gill bought on E-Trade before the tweet he sent last month that sparked that rally that we're talking about, very similar to the rally that is happening this month. We know the SEC is also looking into GameStop options and market manipulation. The risk, though, is if you kick someone that popular with the Reddit crowd off of your platform, many others could follow.
Yeah, and the flow that goes with those meme stock traders is considerable. Careful what you do to your brokerage flows. Charlie, thank you very much. Charlie Wells at tracking the stories. I want to give you a snapshot. We just spent some time on India. Narendra Modi under pressure in terms of acceding to the majority that he needs. What have you got? Nifty is the biggest drop in 4 years going on there. You've got the dollar bid against the rupee. It's the biggest move up in the dollar, down in the rupee in 10 months. Volatility is toxic there today. Volatility ratcheting by 42%. And Adani Enterprises, as you can see, down some 20% at the moment. Let's see how that impacts the rich go narrative for Gautam Adani. Coming up, Secretary Yellen testifies on the first debate in the UK election. We have a lot to keep our eyes on today. Good morning from New York, from Bloomberg, where context matters.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt.
That's why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
Bloomberg Brief. I'm Cranny in New York. Let's check in on what's going to be the focus of your day. The JOLTS, the job openings, factory and durable goods orders at 10 a.m. Eastern. We're going to listen to Janet Yellen, the Treasury Secretary, testifying before Senate subcommittee. That's at 2:30 in the afternoon. Rishi Sunak and Keir Starmer in the UK, they face off in their debate before the election. That is at 4 p.m. whose policies, at the moment it looks on those polls, a potential supermajority for Keir Starmer, if the polls are to be believed, against Rishi Sunak. Some individual movers for you. Pat Gelsinger got on the stage and evangelized by the propensity for AI. It's the only bid-up chip maker on the market this morning. The CEO Gelsinger unveiling a new processor in the battle for AI supremacy. Stellantis, the EV battery venture led by Stellantis and Mercedes, pauses the development of a factory in Germany due to poor demand. GitLab, application software, the company's revenue forecast came in weaker than expected. We're down nearly 4%. I want to leave you with a snapshot of what's going on in currencies. The yen is moving. This is the euro down and the yen higher quite considerably as we see a potential shift in quantitative tightening from the Bank of Japan. It's the second day of gains, and Suzuki confirmed intervention.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
You can forgive a lot of things if growth is remaining resilient.
Expectations of higher growth are now so built into markets. The two-way risk on growth numbers are now really significant.
I really think that the focus, at least for the second half, is going to be on the slowdown in growth.
That's sort of a perfect scenario. We get deceleration in wage growth, economy stays reasonably firm, and the Fed has this clear runway to do what it wants.
As long as the economy is expanding, we're finding opportunities. I think don't overthink it.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market on the S&P 500 this morning, negative by 0.6%. Kicking off June with a day of gains, but only just. We've talked about the calendar all week, many times. We need to talk about the calendar again. Following the weaker than expected manufacturing ISM in yesterday's session, we begin Tuesday, dialing into Wednesday, and looking for this. The services ISM taking on so much more importance. We've been whipsawed by economic data. Bramo will be whipsawed all over again.
The disappointments have been coming in pretty consistently when it comes to U.S. economic data, and it is giving rise or giving fuel to the people who believe that this economy is decelerating at a faster clip than many people, including the Federal Reserve, is really recognizing. This is narrative ping pong. It can shift really quickly, but you get enough of these types of prints, especially with the services ISM, and suddenly you have a trend.
A phrase you'll hear a lot this morning is bad news, and we need to define what bad news actually is before we start talking about whether the bad news is bad news. You know where I'm going with this. So let's talk about some numbers. Payrolls on Friday, the estimate in our survey just nudging a little bit lower to about 185. These are some numbers for you. Bank of America, below 125, bad news could become bad news. Stuart Kaiser City just yesterday, headline payrolls below 150 would be worrisome. How worrisome would sub 150 be this Friday?
Well, it sort of depends on who you ask. You mentioned Bank of America. They say Goldilocks range for equities is between 125,000 and 175,000. You have Stuart Kaiser saying sub 250,000 is negative. You have Citigroup's Andrew Hollenhorst talking about a rapidly weakening economy with payrolls coming in at 140,000. We don't know even how to interpret the data that we're looking at because we don't understand the dynamics behind them, which is the reason why the ranges that you are seeing are ever growing, which is the reason why, as Bank of America came out this morning and said, fragility in stocks is near a 30-year high. People are trying to understand what their paradigm is as stocks whipsaw on a single name basis, unlike what we've seen for decades.
It was only 2 weeks ago we had this breakout in the PMI. Remember that? And the economy was too hot. And now we're having this downside surprise on the SM. And maybe things are too cold. Neil Dutta of Renmax saying this yesterday. You picked up on the same thing. An accident could be brewing.
Basically, he's saying that right now, the economy is probably weakening more than the Fed is going to recognize it, because inflation isn't coming down as quickly, at least in the headline data, as it will be later on. So he thinks the Fed's only going to cut once or not at all, which will be an accident. He thinks that the Fed should cut more because, honestly, to support this economy, you need some more strength. This is the debate right now. We don't understand even where the range of risks are. Is the Fed at a greater risk of allowing inflation to run too hot into next year, as we've heard from a number of people, or at deflating and, frankly, tanking an economy that's losing steam really rapidly? We don't understand. And if we listen to the executives, CEOs, not clear they understand either, because they're saying that high-income consumers are doing just fine. Everybody else, I don't know, it's kind of a crapshoot.
The story could change day to day, and it could change again a little bit later when we get more economic data with jolts just around the corner. Crude is lower for 5 consecutive sessions. Maybe that is speaking to the fear of an economic slowdown. Check out the scores right now across the board. Crude at the moment, Brent crude, a break of 80 in yesterday's session for the first time since February. We are looking at lows we haven't seen since January on WTI. We're down another 2 percentage points. WTI 72.58. Looking at crude and looking at the bond market, yields have been lower as well. 438.84, we're just about unchanged on the session. Equity futures pulling lower by 0.55%. Coming up this hour, we'll catch up with Julian Emmanuel of Evercore. As bets grow, the Fed will have room to cut this year. Former Fed economist Claudia Sahm on why inflation feels so bad. And Bloomberg's Will Kennedy as Brent crude breaks below 80. We begin with our top story, weaker than expected manufacturing data, leaving the door open for rate cuts. Julian Emmanuel of Evercore writing this: volatility is going to rise from these depressed levels, given the catalysts of payroll, CPI, the Fed, and the extraordinary machinations of US politics. Julian's around the table with us in New York. Julian, good morning to you.
Good morning.
How much weight do you put on that data out yesterday?
Well, we have to step back and recognize that, in particular, the last couple of weeks have been really quite extraordinary. So a week and a half ago or so, the Bloomberg Financial Conditions Index printed the loosest it has printed since 1994. Then you had basically the number 3 weight in the S&P 500 over this last week and a half, up 20%. Yields down 20 basis points. You would have told me 2 or 3 weeks ago, if you had the combination of all of those things, the S&P 500 would have been up, what, 2, 3, 4%? We're down. And that points to the fact that the market is now looking at the data differently in an environment where we still have inflation uncomfortably sticky towards that 2.8 on the core PCE.
I've got a friend for you. It's called Marco. He might agree with you. Marco Kalanovic over at JP Morgan said this: a number of macro signals are pointing to economic slowdown or a recession. Market risk sentiment remains positive. Stock markets are close to all-time highs. Basically implies something has to give. Does something have to give here?
We think so. We don't think it is the end of this 2-year bull market, okay? But again, you go back to this idea that even in a non-recession year, the average peak-to-trough drawdown is 13%. And I think based on the events that we've witnessed, let's say, in the last week alone, both geopolitically, politically, economically, and otherwise, one can argue that this is at least an average year.
Which raises this question of what does a drawdown look like? Yesterday, we tried to get one. Initially, the ISM data came out, and it was bad news is bad news. Stocks sold off in tandem with bonds actually getting a bid. And then suddenly, people were thinking, maybe this is a dip. Okay, we're going to buy. And that's essentially the action that you saw at the end of the day. What's to say that's going to really materially change?
Well, the speculative juices over the last several weeks are certainly there. No question about that. And the tendency tends to be is that those types of episodes ebb when the P&L starts deteriorating. So if everyone's favorite meme stock starts heading back towards $20 or lower, and everyone's favorite stock, which is about to split on June the 10th, starts to trade sideways or lower. And interestingly, this idea of stock splits being, outright bullish for a stock is very specious And to us, it has echoes of something that happened in late 2020 when you had two of the other Mag 7 stocks split on the same day, and that really actually was an interim top in the NASDAQ.
Okay, let's give some names to what you're talking about. You're talking about GameStop and NVIDIA, right? You're talking about GameStop, the mean stock that just can't quit. Roaring Kitty, good morning. And then you have this question of NVIDIA and the stock split and how beneficial that'll actually be. Let's start with GameStop. Is there actually any message for the broader market in the rally that we've seen there, in some of the Roaring Kitty type of activity, or is this just an idiosyncratic story that's gotten legs once more because people find it appealing?
Well, to be truthful, the message is the Fed really needs to think very long and hard about cutting rates when you have this degree of speculation still in the markets, buoyed by the liquidity that, as we saw a week and a half ago, had gotten to all-time lows going back to 1994. There needs to be a recognition that the dynamic is perhaps a little bit more finely balanced than this rally would otherwise indicate.
Do you see a parallel between GameStop and some of the speculative activity and NVIDIA and some of the really elevated valuations and this feeling that it's headed to anywhere? It could double, it could triple, it could become a $20 trillion stock in the next, 2 years. I mean, people's expectations are going to the moon. Is that because of where rates are? Is that because of expectations of a Fed rate cut, or just a paradigm shift in a technological advancement?
No, you do have to differentiate. We've been on this program a lot in the last year. We're early to the AI revolution. We are firm believers in the AI revolution. But again, if you go back and you think about the internet in the late 90s and the early 00s, what you had was a paradigm where those types of developments and the good feeling around those share price gains extended the economic cycle, but didn't eliminate the economic cycle.
Where do you think we are? Mid-90s? Late 90s? Where do you think we are?
I would say you're really in the late 90s, because when you think about there's a desire to say, well, this is 1995. This is the dawn of the entirety of it.
Why are they wrong?
Well, they're wrong. Well, first I'll say why they're right. Okay, and why they're right is because you're actually in the early innings of AI adoption, and it will be a game changer, and it will be a productivity enhancer. Will it be a productivity enhancer to the degree that the internet was? That remains very much an open book. You hear Chair Powell sort of poo-poo that idea in the short term. They're wrong because when you think about 1995, the only time the Fed cut rates because it could, not because it had to, the difference was that, yes, the economy was strong like it is now, but core PCE was already at 2.1%. We have a different paradigm, and multiples were 14 times versus 21.5, 22 times.
So it's late 90s. Is the juice worth the squeeze, or is it time to step away?
Well, as an active manager, you need to be invested on the one hand, okay? But the fact is that the market dynamics and the market structure actually afford the ability to hedge really almost like never before, because 5.25% interest rates work, A, because cash is attractive, but B, because selling call options against buying very cheap put options is about as attractive as it gets.
Are you basically saying that as an equity strategist for decades, you like bonds and cash?
Look, bonds is you have to differentiate between bonds and cash here, okay? And I think part of the error of the last year or so was this expectation that cash would become worth less. And what we're finding is that because inflation has remained stickier, cash has retained its value. Bonds are going to be what will work if there is, a downturn. And I think that's part of the message of these last couple of weeks, is that there may not be a downturn, but there could possibly be sort of this growth scare dynamic.
So in other words, are you saying initially cash looked good, but you're moving out the curve because you do see some sort of deceleration?
Very gently. very gently. Our view is that at Evercore ISI, we do expect a slowdown at the end of this year into early next, and that's certainly going to be bond bullish, and it's certainly going to be part of the dynamic that causes the Fed to cut rates. But you really have only started to see these beginning signs of a slowdown, and what you're going to need to see is that inflation to fall in tandem with an accelerating slowdown, if that's the case.
I feel like over the last 10 minutes we've bullied you into sounding more bearish than you actually are.
Well, look, to be clear, we have felt uncomfortable with valuations where they are.
Yeah.
Okay. When you look at the long history of returns, the average return at this valuation on a year look forward is 0. Now, you've also had times like late 20 and into 2021, and obviously, since you asked the question, 99 and into 00, where that has been wrong. Look, those peaks were 28 times earnings. That's 6,300 on the S&P 500 right now. What we're saying is that it's time to catch our breath, given all the uncertainty of these dynamics, particularly given the fact that the price of uncertainty, volatility, is so incredibly cheap right now.
Julian, it's good to see you. Thank you, sir. Julian Emmanuel of Evercore, kicking off trading with us this morning. Equity futures negative by 0.6%. With an update on stories elsewhere, here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. The rupee fell and Indian stocks dropped the most in 4 years as early election results indicate the race there is much closer than any of the exit polls estimated. Narendra Modi and his BJP party are seeking a third term in power, but initial tallies signal the party is struggling to win a majority of seats in national elections. Airbus may be closing in on a deal with China. Bloomberg News has learned the plane maker is negotiating a major sale of more than 100 aircraft to China. Talks have gained momentum since President Xi Jinping visited his French counterpart Emmanuel Macron last month. And a glitch in a software update is being blamed for trading halts at the New York Stock Exchange yesterday. The glitch also led the NYSE to incorrectly display 99% drops in companies including Warren Buffett's Berkshire Hathaway. The disruption was resolved after 45 minutes when the exchange reverted to running a different software. The NYSE will cancel the bad trades in Berkshire and is reviewing other erroneous halts. That's your Bloomberg brief. John?
What a mess. Yahara, thank you. More from Yahara in about 30 minutes' time. Equities a little bit lower this morning. We're down by 0.6%. A massive week of data. Coming up next, the weight of inflation.
We've got a lot more work to do on the price side. Prices are still too high, and we have an aggressive cost-cutting agenda that we're going to continue to push.
That conversation just around the corner. Live from New York City this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt, which is why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
Live from New York City, welcome to the program. Equity futures near session lows. We're down by 0.5%. The yield's pulling back too. We're down a basis point, 437.67. Much more on crude. 5-day losing streak. More on crude a little bit later. WTI 72.56. We're down by 2.2%. Under surveillance this morning, the weight of inflation.
We've got a lot more work to do on the price side. Prices are still too high, and we have an aggressive cost-cutting agenda that we're going to continue to push. Inflation down 60% off of its peak. That translates into real earnings, feeds back into consumer spending. And, you know, let's take a close shave with Occam's razor, if we will, and just kind of call that a healthy, kind of perpetual motion economy that's been reliably delivering for working households for a while now.
So here's the latest. Despite cooling inflation data, rising prices are making Americans critical of the economy. According to a Gallup poll last month, 41% of Americans name inflation or the high cost of living as their top issue. The cost of owning or renting a home ranks second at 14%. Claudia Sam of New Century Advisors writes, the people who experience the U.S. economy continue to disagree with the people who measure it. And the most likely reason is inflation. Most Americans still see it as a major problem, while most economists do not. Claudia joins us now for more. Claudia, let's get into this. It's a fantastic piece. Help us understand. Are we measuring it wrong? Is it just a difference of perspective?
It's more about the perspective. Inflation is just a change in prices. Right? It is completely legitimate for most Americans to compare back to 2021 before prices took off. And it is completely legitimate for economists to look at, hey, what's happened over the last 12 months? Right? So it's all the same thing. We're just using a different perspective. And unfortunately, we end up talking past each other. And this is not about semantics. Right? There's a real problem or a real disconnect here.
Claudia, which perspective do you think is more important to policymakers?
Well, policymakers serve the American people, right? So they need to look on all fronts. And again, it absolutely makes sense why people use the overall increase in prices as their reference point. And it's really important that we understand that the prices are not increasing at the same pace. So again, policymakers serve the people, they do not serve economists. And so they need to focus on that. And yet all these pieces go together. There is not tension between the definitions.
So, Claudia, what's the policy shift that comes from the recognition that people's feelings aren't wrong and the way that they're looking at it isn't wrong? And if policymakers serve the people, well, how should that shift what policies they follow?
Right. So policymakers need to move past the idea that this is all about the economics. Right? There are perceptions here that are very important. A big part of the piece, once I move past what the definition of inflation is that you have a big disconnect between how people view their own finances. There was a recent survey that said about 70% of people view their own finances at least good, comfortable. And yet when you ask them about the national economy, the same people, about 25% say the economy's good, right? So this does not make sense. It doesn't make sense in tying it back to economic conditions because those people, they're representative, they ought to all add up and tell us about the national economy. And that's the thing. It's a real puzzle. This is what policymakers, particularly at the White House, maybe less at the Fed, need to understand, and they got to stop talking to economists about this. This is out of our lane.
Yeah, I guess that the question is, as John said, is this a messaging exercise? Yes, it's not totally rhetorical. At the same time, is this a matter of saying to people, look, inflation is still a real problem, which is the reason why we're holding rates where they are? Or is it different? Is it saying that, for example, we can cut rates on the margins to help these people or maybe move houses more aggressively on the market and then take a look at where inflation is in a year? I mean, how does this change from a messaging standpoint, if not from a policy standpoint?
I don't think it's messaging, right? There is something going on that make people pretty okay with their finances. Their finances depend on what are the interest rates? Have they bought a home? Can they buy their groceries? I mean, if you ask them, they're like, we're doing okay. I mean, not everybody says they're doing great, but I mean, these are the things that economists or the Federal Reserve, they want to get out there in the economy, slow inflation down. They use interest rates. How does that affect people? But if you ask them how that is affecting them, it's like, okay, we're doing it. But if you ask them how things are going, big picture in the economy, is bad, right? So again, there is a disconnect that, they need to figure out what is going on, and it's not entirely, it's part of it. Part of why people are a little downbeat has to do with inflation, but there's something more. And that's what, not the Fed. Again, I don't think the Fed needs to worry about the messaging. They're going to do what they do. But there's a lot of other policymakers who are out there in front of people, and they can't act like, well, cutting prices or getting interest rates down is going to fix that.
Well,
it might help some people, but it's not going to fix that disconnect.
We'd love your view on Fed policy while you're with us, Claudia. I'd love your view on this. Lisa mentioned Neil Dutta of Renmark. This is what he's got to say at the moment. He says there is a potential accident brewing. He has some conviction that core inflation is slowing, but hawkish rhetoric will look offside relative to the incoming data. Do you think there is a bit of an accident brewing at the Federal Reserve?
I'm extremely frustrated that when the Fed talks about the risk to the economy, that they're hyper-focused on inflation could take off. We might have to hike. I think, and I agree with Neil in the sense that we should be talking about the other risk. Employment could really weaken, and then we're having a Fed that's not cutting 25 at a meeting, they're cutting 75, right? And we are not talking about that risk. It's not my baseline. But I think we ought to put all the possibilities on the table and really think about them and prepare markets, prepare people for, hey, there might be something else in the card other than hiking. And it's just not in the conversation, which is mind-blowing among Fed officials.
One of the reasons why is it's just been so difficult to get the economy right and to understand the trajectory that we're looking at. Just to sort of give you a sense of, or give us a sense of where you think policy has had an effect, do you think that higher rates have actually kept home prices high by reducing the volume of sales?
The Federal Reserve, through the unconventional monetary policy, so the buying of the mortgage-backed security, they have completely what's the right word, have affected the housing markets in a way that have been unusual and, frankly, detrimental, right? Because rates moved up so fast. Yeah, I'm trying to come with the right word. And so I think it's really hard to look at the housing markets and give a diagnosis of what the Fed did, because you have to put the whole picture together when they were pushing down house prices and now they're going up. And I think they're just trying to, they've got a mess they're trying to unwind, and yet that is one of the interest rate sensitive sectors. And one could argue that this unusual setup is why the transmission, so their higher rates, haven't quite pulled into the rest of the economy.
Interesting. Claudia, well handled. As always, Claudia Sam, it's good to hear from you. Thank you. Equities right now on the S&P down by 0.5%. Crude, 5-day losing streak. Brent crude breaking below 80. We'll catch up with Bloomberg's Will Kennedy on the other side. Live from New York, this is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It was quite the reversal in yesterday's session. We were down and down hard after the ISM, and then we recovered and finished in positive territory this morning. We're down again by 0.5% on the S&P. On the Nasdaq, we're off by 0.5%. This time yesterday, the Russell was up more than 1 full percentage point, and now it's down 1 full percentage point. We are all over the place and whipsawed from data point to data point. Switch up the board and get to the bond market. 2-year, 10-year, 30-year. The 2-year, 479.95. It was only a few weeks ago, May 23rd, when we had a stronger than expected PMI, and we were all talking about the economy running too hot. That morning, the 2-year opened up at about 487-ish. We've pulled back down to about 479.95. Just data point to data point. And Lisa, I know we've both read the same note. Kit Jukes, SocGen. It takes more than one soft ISM manufacturing print to signal a change in the economic outlook. But if it only takes 2 swallows to signal the arrival of summer, then ISM services data are important. We talked about starting Tuesday, dialing into Wednesday. That data point has taken on a lot more weight in the last 24 hours.
We're looking for narratives. We're sort of searching for what to sort of hook into in terms of a trajectory going forward for the economy. If the ISM print that we saw yesterday in manufacturing was a read-through to Wednesday and what we get tomorrow, then all of a sudden people are going to talk about a more rapidly deteriorating U.S. economy, slowing to maybe slow, not necessarily just slowing, but not slow.
What we talked about repeatedly yesterday at the end of this program. Let's switch at the board and get to crude. 5-day losing streak on WTI. This is what it looks like right now. Brent crude's at 76.87. WTI is down another 2.2% at 72.57. There was a big supply side story in the mix to start yesterday. But once you get a data point like the one we got mid-morning in America, people start to talk about the demand side of the equation a little bit more. Are we talking about supply here, or are we talking about demand?
Well, we never really know with this. On one hand, you've got the supply story with OPEC Plus agreeing to bring back online certain barrels later in the year, starting in October. That was a potentially dovish signal to the oil market. But then there have been numbers of people talking about peak gasoline prices, the fact that even with some of the incredible increase in driving season, et cetera, the demand for oil and gas just isn't there. So to your point, hard to gauge out what exactly this is. Nonetheless, a lot of people are talking about potentially more negative price pressure on the margins for now, at the moment, until the next narrative comes into play.
The lowest level since January. Brent crude right now, 76.88. Under surveillance this morning, weaker than expected factory data sparking a rally in treasuries. ISM manufacturing falling to the lowest level in 3 months. We'll get factory orders, durable goods, and JOLTS job openings, all due at about 10 a.m. Eastern time. It was the economic data yesterday that got this market really started this week. ISM was the weakest in 3 months, sub 50 in contraction. New orders, the biggest drop since June 2022. Will that be confirmed by services just tomorrow?
Michael Darda over at Roth MKM quantified it in terms of what the read-through from that new order statistic that you talk about is to the S&P 500. He said that it's the levels there are consistent with declines in both the S&P 500 earning estimates and capital spending growth. So just putting out there that price to perfection is probably an accurate way to characterize where the market is based on what ISM manufacturing numbers are telling you. Again, is this a quirk in the data? We've seen it in other peripheral data. The S&P Global manufacturing data comes to mind in particular.
Here's another economic data point. This story right here. President Biden cracking down on immigration. Bloomberg reporting he'll sign an executive order looking to prevent new asylum claims by migrants who walk across the U.S.-Mexico border. The move would stop claims at the border if crossings hit 2,500 a day. I call this an economic data point. We'll catch up with Steve Englander of Standard Chartered a little bit later, who will point to this issue as a big issue in the labor market. Is this going to be a big data point going into payrolls, not this Friday, but in a few months from now, a few quarters from now, maybe even a year from now?
Tony Capuano of Marriott yesterday saying immigration has actually been really important for them in order to get enough people to staff their properties. He was talking about how he's looking for more permits to actually bring more people in. We have asked people repeatedly this, and to some degree, it feels like it's sort of colored by a certain politicization that has had people disagree on just basic fundamental economics. You have had a number of Wall Street houses come out and say the immigration that we have seen has kept down wages and has increased growth pretty dramatically. Unclear how quickly that could reverse and how much exactly we've gotten a boost from that.
We'll put some numbers on that a little bit later this morning. Look out for that conversation. Elsewhere in the commodity market, crude prices falling below $80 a barrel. It's the lowest level in nearly 4 months. An OPEC Plus decision to bring more oil to market despite an extension of some production cuts is raising supply concerns. We can catch up with Will Kennedy now in London. Well, let's go straight to it. I asked Lisa this question. Help us out. Is this a supply side story, or are we starting to worry about demand?
As always, I'm going to be boring and say that it's both. Clearly, what traders are confronted with right now, though, is a situation where they're starting to see the prospect of those OPEC cuts, which have underpinned the market in recent months, being unwound against a period where the demand outlook may, as you're alluding to in your economic commentary, be getting more uncertain. It's worth pointing out that thus far, since the end of the pandemic, demand has been strong and tended by historical standards to be strong, adding 2 million barrels a day last year, which is very healthy, and by historical standards strong again this year and ahead of expectations. So that may well continue, but I do think that the decision that OPEC made at the weekend probably makes the market more vulnerable to any wobbliness in demand.
Well, can we talk about the decision over the weekend? A bit of confusion around it. On the one hand, they're extending. On the other hand, they could boost supply a little bit later this year. Where should the emphasis be?
I think the emphasis should be on the fact that it was a deal that enabled OPEC to continue presenting a united front until the end of next year and deal with some slightly tricky issues. The most important issue that they managed to deal with was the production level for the UAE. The UAE has always felt that it was having to do more heavy lifting within the current quota setup and had been campaigning for a higher quota. Part of the agreement delivered that. They're going to get 300,000 barrels a day extra next year, which no one else is going to get to. But to make sure that that was not taken too badly by the market, they promised to restrain the broader production target until 2025. So it is a mixed picture. It takes some understanding, but I think it was a deal that enabled them to deal with some tricky issues and preserve the unity of the group going into next year. And I think the bullish argument is that we have a much clearer idea about what policy is going to be until the very end of 2025.
Well, just to go to the demand side of things, do we have any sense? I mean, travel season is alive and well. A lot of people are on the roads, traffic jams galore, congratulations. But there is this feeling that it's not that people are driving less. It's not that people are flying less. It's just that maybe they're using less fuel, or that's the reason why demand isn't as great. I mean, what's your sense? Is it because of some sort of economic downturn, or is it just because of greater efficiency, or is it just because of U.S. production that's offsetting any incremental gains in demand?
I think the broader picture is that despite some signals around the edges that things may be getting a bit softer, that underlying demand remains strong. I was looking at someone pointed out to me this morning a chart from the oil trader Vitol that's saying jet fuel demand around the world is now for the first time truly above pre-pandemic levels. We still think people are driving a lot. In fact, gasoline demand globally looks strong. There's a bit of weakness here and there in diesel demand, which is more leveraged to industrial parts of the economy. But overall, I don't think there's a compelling reason to say demand is weak. Clearly, if people are getting concerned about a slowdown in some parts of the economy, it may not be quite as strong as previously thought, but I don't think it would be fair to present a demand weakness narrative just yet.
I guess then, given that there really isn't necessarily weakness materializing, and given the fact that on the supply side, things can change really quickly, how do you understand the story, for example, from Maersk, AP Maersk, the shipping company that came out yesterday, increasing its profit forecast for the second time in barely over a month as they look at some of the disruptions that they're seeing and just the fact that they're going to be able to continue charging a significantly higher rate to ship goods? Does that kind of disruption give people pause? Are people still talking about the potential for this to percolate over into the oil sector, oil tankers getting disrupted, or have people basically become benumbed to some of the possibilities that haven't come to pass?
I'd make 2 points on that, Lisa. First, that the world economy has adjusted, that shipping oil around the world has adjusted to the problems in the Suez Canal, and oil's getting to where it needs to go. But it has had a material impact on the oil market because ships having to sail these longer routes, and that's good for Maersk's profits, but it's also been very good for oil demand. By some estimates, it's probably added several 100,000 barrels a day of extra global oil demand just because those ships are having to go that much further around Africa to get from Asia to Europe. So it is another reason why the demand picture is still pretty healthy.
Well, let's just finish on the demand picture more broadly in the commodity complex. Are you seeing any confirmation of concern beyond crude in places like copper, iron ore?
I mean, the copper has obviously been a bullish story over recent months. I think there's a debate within the metals trading community about how much of that is based on fundamentals in the here and now, which don't necessarily look super strong, compared with the flow of investor money that's come into copper because this narrative has been developed about the medium-term outlook around electrification, around batteries, around EVs, and a lack of supply. So there may be a short-term, medium-term mismatch there, but I don't think we're at a stage where people are looking around the commodity complex thinking the global economy is about to get a chill. Now, that may come, but that's not what we're seeing right now, I'd say.
Will Kennedy, thank you, sir. From Bloomberg out of London on the latest in the commodity market, both in crude and in copper at the end there. Copper at the moment, a break of 10K. We're down about 1.5% in London trading. Let's give an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Brexit architect Nigel Farage is running in the UK's general election next month. Farage's announcement comes less than 2 weeks after he said he would not run because his time would be better spent helping Donald Trump get back into the White House. Farage has stood to be an MP unsuccessfully 7 times, but is currently more of a household name than some conservative ministers. Maersk said the world supply lines are more impacted than first expected from ongoing disruptions in the Red Sea. The global shipping company raised its profit outlook as disruptions remove capacity from the global fleet and provide a boost to freight rates. It's the second time in about a month Maersk has boosted its outlook, with the stock rising 22% in the month of May. And E-Trade is considering banning meme stock leader Keith Gill, known as Roaring Kitty, from its platform. The Wall Street Journal reporting E-Trade and parent company Morgan Stanley are concerned about potential stock manipulation around his recent purchases of GameStop options. Gill bought a large volume of the video game retailer's options through E-Trade last month, reigniting a meme stock frenzy. Then, this past weekend, he did it again, posting a screenshot of what appeared to be a $116 million position in GameStop, sending the stock up 31% yesterday. That's your Bloomberg Brief. John?
Yahara, thank you. We'll see Yahara again in about 30 minutes' time. Let's save the conspiracy theories just for a moment. Let's go to that Wall Street Journal piece. According to people familiar with their internal discussions, we talked about one concern that E-Trade has. There's 2. The debate includes whether his actions amounted to manipulation, 1, and whether or not the firm is willing to risk drawing the attention of his meme army by removing him. 2. The second point's far more interesting, isn't it?
Especially based on what happened to Robinhood when they tried to take him off their site. I mean, there's actually a precedent for this, and if they do have that army withdraw from E-Trade, well, how big is that army? I mean, clearly he has quite the following who are pretty avid red band supporters.
And never mind the legal concerns, just sort of the concerns that they come after the platform. We'll talk more about that a little bit later. Up next on the program, the case for a July cut.
What we think we're going to see is softer inflation and softer activity in labor markets. If you put both of those together, that's going to be a pretty powerful sign to the Fed that it's time to start cutting rates.
Really interesting conversation with Steve Englander and Standard Chartered coming right up.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. We do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York, welcome to the program. Equity futures negative here by 0.5% on the S&P 500. Rally in the bond market yesterday. Yields lower, down again by almost a basis point on a 10-year, 438. Under surveillance this morning, the case for a July cut.
It really comes down to the data. We can spend all of our time listening to the Fed speak, and that's important, and it gives us some guidance about where they want to go. But where they will go will depend on the data. And so what we think we're going to see is softer inflation and softer activity in labor markets. If you put both of those together, that's going to be a pretty powerful sign to the Fed that it's time to start cutting rates.
So here's the latest. Treasury yields slipping to their lowest levels in more than a week after weaker than expected factory data in the US. Investors now looking ahead to a busy slate of jobs data with jolts at 10 a.m. ahead of the payrolls print on Friday. Steve Englander of Standard Chartered writing this. A July cut is our baseline. There are two more PCE releases before the July meeting, so there is considerable room for core PCE to slow. Steve is with us right now. Steve, good to see you, buddy. I saw it in my inbox yesterday before the ISM data came out and not afterwards. You didn't think this market was pricing a big enough probability on the prospect of a July rate cut. Talk us through the call.
Well, first, the market probability is like 10 or 15% right now, just a couple of basis points priced in. So the very almost de minimis in terms of rate cut probabilities. What we have seen is some deceleration in the numbers in terms of PCE inflation. One of the things that we've looked at is if you look at the February 2024, March 2024, April 2024, they're all below their corresponding months in 2023. So, at the beginning of the year, there was a seasonality argument that maybe price increases are bunched at the beginning of the year. That possibility still rises. The other part that's there, and that's something Andrew was alluding to, you take a look at GDP now, like 3 weeks ago was over 4%. 10 days ago it was like 3.5. Now it's 1.8. The numbers have shown a trend towards softening. And, the Fed has been kind of mixed in terms of saying what constitutes a real slowdown that would get everybody on board for a cut. But they've been unanimous almost in terms of saying that if we begin to see the economy slowing down, that's enough. I mean, because they really, really believe in the Phillips curve, and they would think that that's the Phillips curve manifesting itself.
Steve, you pointed to 2 inflation reports between now and July as a reason that the door was still open, the window was still open for a cut. You didn't talk about payrolls just then. Can we talk about that? You mentioned Andrew Honhorst over at Citi. His call on Friday is 140. And he thinks once you start to get prints like that, that opens the door for the Fed to make a move in July as well. What's your number for Friday, and how does it inform the ultimate call?
I mean, we're at 195, but keep in mind that we see a lot of immigration in this number. And, we reported that, based on data that we have on employment authorizations that are being handed out, that, over the last 6 months, maybe 110,000 per month of NFP are people who cross the border kind of, called undocumented, applying for asylum after a period of time. They get work permits and they can work for Bloomberg, they can work for Standard Chartered, and they can get counted in NFP just like anybody else.
Given that, Steve, can you give us a sense of why this is making it difficult for the Fed to understand the real economy? In other words, what kind of distortion does this create for people who are trying to understand the direction of the economic data points?
I think if you listen through sort of a week's worth of Bloomberg surveillance, 90% of the conversation will be on demand, in terms of macro impact. In terms of being able to understand supply shocks, what their magnitude is, what their impact is, the market and the Fed have a lot of trouble because typically those are unusual. It's not the same as saying, okay, last year we had 1% fiscal thrust. This year we're having 0.5% fiscal thrust. Figure out the impact. It's usually very hard to assess what the impact is. And as we discovered, until we were able to get the data on authorizations, it's hard to get any kind of numbers on the magnitude of the supply shock.
So are you basically saying that the immigration supply shock, which essentially has created these pretty robust labor market numbers, has masked an underlying weakness that you think the Fed needs to address as soon as next month, and that they may have to address it repeatedly this year with further rate cuts at a time when the data may look good but will quickly deteriorate, especially if immigration stalls? Is that basically the scenario that you're laying out?
Roughly. We think the economy's slowing down. We think that the data are suggesting that. You take a look at some of the data on consumer finances, you take a look at where most of the surveys are on employment are a little bit downbeat, especially the surveys that would capture traditional workers, not kind of new immigrants. And we do see this downward slow, but it's downward progress in inflation. It does leave them room to cut. July, obviously if we think they're doing 25 and the market thinks they're doing 3, there's a big difference. But I think the case for July, or the July scenario is a solid one, much more solid than the pricing would suggest.
Let's run with your scenario. Let's push it through the FX market. Steve, what does it change?
Well, look, I think that the dollar strength that we've seen has been driven a lot by the worry that, maybe the Fed's not going to cut, that the limit, some people sort of speculating maybe the next move is a hike. We don't think so. We think they're going to cut twice this year. I think if we began to see the Fed cutting and the beginning of a rate cutting cycle, because it's not going to be one and done, a lot of the dollar strength that we've seen could be eroded. Probably see carry trades, become even more fashionable. Things like the yen, which were sort of, kind of getting bid up because the market couldn't resist, 350, 400 basis point spreads. All of a sudden, if those spreads start compressing, sort of this sell yen story becomes a lot less attractive, especially if the BOJ begins its hiking cycle. So I think it would be a big deal. And I think it's qualitative as well as quantitative in the sense that there's a big, sort of bolus of fear in the market that the Fed's not going to move and that every central bank that cuts is doing it at its own risk. If the Fed sends a signal that it's going to move, I think that gets relieved and the willingness to sell dollars gets, is increased.
Steve, can we throw in some politics as well? The importance of voting. In Mexico, big win. In South Africa, in India, tighter than expected election, sort of outside the G10 remit that you have, Steve. But just walk us through the politics and how important those elections are going to be this year.
I can barely deal with politics in, Manhattan, never mind, what's happening elsewhere. Look, we have written that, the big win in Mexico raises the possibility that, that they can make more dramatic moves. And we've kind of shifted our positive view on Mexico a little bit, but, let me leave it there.
Steve Englander of Standard Chartered, I'll let you leave it there. Steve, it's good to catch up, buddy. Can we bring up dollar yen again? Steve mentioned Japan just briefly. Bit of yen strength on the screen today. Report coming from the team here at Bloomberg. They're looking at reducing bond buys as early as June. This is the BOJ looking at reducing bond buying as early as June. A bit of yen strength on the screen today.
To me, actually, this is one of the covert stories that might become very much front and focus later this year. Torsten Slok over at Apollo is pointing out that if you get yen strength in tandem with potential rate hikes, it's hard for me to understand the cycle there, rate hikes at a time where people are looking at the highest yields long-term on Japanese JGBs going back to 2012, well, that could take a whole lot of the demand for treasuries away. So that on the margins could lead to higher treasury yields, considering how big of buyer base the Japanese have been for U.S. government debt.
Which explains why every single bond investor on the planet who's been on this program in the last month has been going to where? To Tokyo, to Japan. And not just because dollar yen's been close to 160 and they want a vacation. They need to understand what's happening in bond markets.
I mean, honestly, you need to understand what exactly the demand is. I will say, to be honest, one of the offspring is going to Japan on a class trip.
Oh, really?
We got a lecture from them about behavior and what there is the expectation.
Hang on a minute, the kids lectured you about behavior?
No.
The school lectured them?
The school about, for example, you should not be on your phones. You should not answer your phones on the subway. It's not like the New York City subway. Do not, swing around on the poles. Do not scream across the subways. It was this whole incredible lecture.
Animals or children? What's going on?
You haven't gone on the subway, and frankly, what's the difference?
True.
Moving on.
154.92, very respectful culture. Dollar yen there. Coming up in the next hour, this is what the lineup looks like. Wei Li of BlackRock, Bloomberg's Josh Wingrove, Boeing CEO Dave Calhoun sitting down with Bloomberg's Guy Johnson. You do not want to miss that. It's going to kick off at about 7:25 Eastern time, so look out for that conversation. We'll take about 15 minutes of it. It's going to be very, very cool to hear the latest from Dave Calhoun. And we'll touch base with Krishna Mamani of Lafayette College. We've said it a million times already. We're only 2 days into the week. The calendar this week is absolutely stacked. After the weaker than expected ISM yesterday, the focus is going to be on the services ISM tomorrow, a jobs data a little bit later, an appetizer for all the jobs data you'll get through the week, including jobless claims on Thursday and payrolls on Friday. The second hour of surveillance up next.
From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove